1, 2. 1, 2. 1, 2. 1, 2.
I'd like to start on time. There you go. Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is entitled Oversight of Prudential Regulators. Without objections, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And I'm now going to recognize myself for 4 minutes for the purposes of an opening statement. I want to thank our witnesses for testifying today. You're here at a pivotal moment for our economy. The recent turmoil in the banking sector could not come at a worse time. The Biden administration and many of my colleagues on the other side of the aisle and Capitol want to treat the symptoms rather than the disease. Our country is suffering from an inflation problem, plain and simple. Driven by the economic mismanagement of this administration, inflation is the underlying cause of the volatility we're experiencing now. My Democratic colleagues will roll their eyes just like they did every time Republicans sound the alarm on skyrocketing prices over the past 2 years. But let me walk you through it. When Democrats forced through their partisan $2 trillion so-called American Rescue Plan, they lit the fuse on runaway inflation. Instead of addressing this problem, the Biden administration went on a roadshow trying to explain away higher prices. They used the words like transitory, which, to be frank, didn't age well. The Fed was late to the game in responding to inflation, and they admit it. They had to play catch-up and raise interest rates 500 basis points at the fastest pace in modern history. This injection heightened interest rate risks into the financial system. Regulators and supervisors at the Fed were, again, late to react. Now, 3 of the 30 largest banks have been shuttered. There is still market volatility within regional banking, and we are now staring down a credit crunch as banks of all sizes anticipate more onerous regulations and market scrutiny. So let me be clear. If Congress and this administration do not respond correctly, we are just at base camp for the economic woes our country could face. A one-size-fits-all regulatory response to this crisis, which has been signaled by this administration, will work against promoting a vibrant banking system with institutions of all sizes providing a variety of services. Instead of a balanced system with small, medium, and large institutions, it will look more like a barbell banking system, with dominant too-big-to-fail banks on one end, as anointed by the government, and banks at the other end, too-big-to-fail banks anointed by Dodd-Frank, and government backstops on one end, and a scattering of very small banks relying on government subsidies to survive on the other end. Such a barbell banking system with a missing middle of healthy regional banks is not good for communities across America. Vice Chair Barr, you've signaled your desire to go beyond reviewing supervisory failures that contribute to the recent bank failures. You have used this crisis to justify Progressive's long-held priority to increase capital requirements and impose new regulations on banks. That predates this crisis, but you're using this crisis to justify your pre-baked ideas. The Fed's internal review, along with FDIC's report and recommendations on deposit insurance, lay bare the playbook for this administration's response to this crisis. More regulation, more government control, and more spending. I know my colleagues across the aisle will use today's hearing to discuss the debt ceiling, and I welcome that debate. We serve in the only institution that has actually addressed the debt ceiling. Because I think frankly, I think what we have now is a larger debate about the economy, not just about the debt ceiling. And inflation and the spending is the reason why we're dealing with the debt ceiling at this time. So I'm glad that we acted and the House of Representatives acted, and the President's now finally coming to the table to negotiate with the Speaker. But out-of-control Washington spending that led to this uncertainty that we're feeling in banking, that the American families are experiencing, it's the result of spending out of Washington, and Republicans are working to address that spending issue. I now recognize the ranking member for 4 minutes.
Thank you very much, Mr. Chairman. Good morning, everyone. First, I'd like to welcome our banking and credit union regulators who are here to testify before our committee today. On the heels of the collapse of Silicon Valley Bank, Signature Bank, and most recently First Republic, it has been the swift action by regulators in conjunction with the Biden administration that have not only protected depositors from harm, but ensured the safety of the United States banking system. Americans can continue to rest assured that despite the recent events, their money is safe and that none of the actions taken by our regulators will cost U.S. taxpayers a single dime. Recently, released reports from our nation's regulators confirm that Democrats have long been sounding the alarm on a toxic combination of Trump-era deregulation and mismanagement by irresponsible bank executives and board members caused the recent bank failures. While regulators must be more aggressive in their supervision of banks, it is the responsibility of bank executives, first and foremost, to take corrective action when regulators identify deficiencies. Since 2018, executives from both Silicon Valley Bank and Signature received multiple warnings. But they ignored those warnings and did not take action. These bank CEOs didn't just run their banks into the ground, they also put our nation's depositors and entire economy in jeopardy. Unfortunately, rather than take action to hold these bank CEOs accountable and working in good faith to get to the bottom of the recent failures, Republicans are using this hearing as an opportunity to point the finger at regulators. Republicans do not appear interested in crafting legislation that would address the regulatory gaps and weaknesses exposed by these recent failures. Instead, they have proposed a slew of bills focused on so-called transparency, completely and willfully ignoring the fact that regulators have published extensive reports and shared other materials that take a deep dive into the failures and emergency response. In addition, several of the Republican bills would limit emergency tools regulators just use to stabilize the situation, making it harder for them to respond to future emergencies. However, our committee will finally hold its first hearing with the Silicon Valley Bank, Signature Bank, and First Republic Bank executives tomorrow after Democrats repeatedly please to Republicans. But I remain deeply disappointed that we're holding such an important hearing at the subcommittee level. This means fewer members will be there to get answers for their constituents, fewer questions, and a shorter hearing. Unfortunately, my request to Chair McHenry to hold this at the full committee has not been fulfilled. This is a stark difference from the leadership Democrats have demonstrated during this time. Through briefings, letters, and policy solutions, committee Democrats are the only ones working around the clock to get answers for the American people and hold the bank CEOs to task. I urge my Republican colleagues to finally join us in this effort. So I look forward to this hearing. I thank you, and I yield back the balance of my time.
We'll now recognize the Chair of the Financial Institutions Subcommittee, Mr. Barr, for 1 minute.
Thank you, Mr. Chairman. Today's hearing is especially timely given recent bank and supervisory failures. Rather than providing timely responses to questions from this committee, the Fed and FDIC decided to produce public-facing reviews of their supervisory shortcomings and push inapt policy recommendations. Failure to timely respond to this committee's questions represent a lack of transparency and accountability. As of last night, we still have not heard responses from Mr. Barr or Mr. Grunberg from a March 29th hearing, even though responses were requested to be in by April 28th. Regulators should not race to set narratives in the minds of the American people. The report by Vice Chairman Barr accurately highlighted the idiosyncratic nature of the SVB business model, but it does not justify imposing new onerous and complex regulations on banks that have experienced deposit outflows due to no fault of their own. In the face of a growing credit crunch and risk of recession, moving rapidly to increasing capital requirements on an already well-capitalized banking system would be a mistake. We want to avoid a barbell banking system with a few too-big-to-fail banks and a scattering of small banks. To do so, regulators should not be blocking mergers and acquisitions, imposing excessive regulation on regional banks, or imposing burdensome requirements that hinder de novo.
We'll now recognize the ranking
Yield back.
member. No time to yield back. We're going to go and recognize the ranking member of the Subcommittee on Financial Institutions, Mr. Foster, for 1 minute.
Thank you. In recent years, neuroscientists have understood that the human brain does much of its learning not just by living in the moment and observing cause and effect, but by replaying events of the recent past, both as they occurred and as they could have occurred with different behavior of the participants. So the questions for today's hearing are not only what actually happened during recent bank failures, but also what are the rules and incentives that, had they been in place, would have caused these failed banks to diversify their depositor base, to appropriately hedge their interest rate risk, and to raise capital early while they still could. I was also encouraged by Vice Chair Barr's reiteration in his written testimony that major rule changes coming out of this episode, as well as presumably out of the holistic capital review and Basel III Endgame, will take place at a measured pace with opportunity for input from both Congress and industry. This is important since the rule changes will have large effects not only on safety and soundness, which is your bailiwick, but on bank consolidation, which is very much ours. Thank you. I yield back.
Gentleman yields back. Well, today we welcome the testimony of the Honorable Michael S. Barr, Vice Chair of Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Grunberg, Chairman of the Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, Mr. Michael Sue, Acting Comptroller of the Office of Controller of the Currency, and the Honorable Todd Harper, Chairman of the National Credit Union Administration. We thank each of you for your time. Each of you will be recognized for 5 minutes for oral presentation of your testimony. Mr. Barr, you're recognized.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify today. Overall, the U.S. banking system remains strong and resilient, and depositors should feel confident that all deposits in our banking system are safe. At the same time, recent stress in the banking system shows the need for us to be vigilant as we assess and respond to risks. My review of Silicon Valley Bank's failure demonstrates that there are weaknesses in regulation and supervision that should be addressed, and I am committed to doing so. I am also committed to maintaining the strength and diversity of the banking system so that it continue to provide financial services and access to credit for households and businesses. As we consider adjustments to our rules and supervisory practices, I am sensitive to how changes may affect banks in the current economic environment. My written testimony and accompanying supervision and regulation report provide details on conditions in the banking sector and supervisory and regulatory efforts of the Federal Reserve over the last 6 months. Let me turn to the SVB review. Immediately following SVB's failure, I led a review of the Federal Reserve's supervision and regulation of the bank. The resulting report takes an unflinching look at the conditions that led to the bank's failure, including the role of Federal Reserve supervision and regulation. There are 4 key takeaways from the report. First, SVB's board of directors and management failed to manage the bank's risks. Second, Federal Reserve supervisors did not fully appreciate the extent of the vulnerabilities as SVB was growing in size and complexity. Third, when supervisors did identify vulnerabilities, they did not take sufficient steps to ensure that the bank fixed those problems quickly enough. Fourth, the board's tailoring approach impeded effective supervision by reducing standards, increasing complexity, and promoting a less assertive supervisory approach. The 4 key takeaways show failures by SVB's board and senior management and failures by the Federal Reserve. Next, I will outline briefly how we can strengthen both our regulation and supervision based on what we have learned and based on the Federal Reserve's existing authorities. On the regulatory side, SVB's failure confirms the importance of strong levels of bank capital. While the proximate cause of SVB's failure was a liquidity run, the underlying issue was concern about its solvency. Stronger capital will guard against the risks that we may not fully appreciate today and will also reduce the costs of bank failures. In addition, we need to reconsider some of our prudential requirements. These include evaluating how we treat available for sale securities in our capital regulations, how we supervise and regulate a bank's management of interest rate risk, how we supervise and regulate liquidity risk, and how we oversee incentive compensation practices. Any adjustments to our rules would, of course, go through normal notice and comment rulemaking and have appropriate transition periods. I also plan to improve the speed, force, and agility of supervision. Supervision should intensify at the right pace as a bank grows in size or complexity. Once identified, issues should be addressed more quickly, both by the bank and by supervisors. Moreover, we need to ensure that we have a culture that empowers supervisors to act in the face of uncertainty. I want to reiterate that the banking system remains strong and resilient. Recent events demonstrate that we, as regulators, must do better, and we will. Thank you, and I look forward to your questions.
Now recognize Chairman Grunberg for 5 minutes.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for the opportunity to appear at today's hearing on oversight of prudential regulators. The U.S. banking industry has proven to be quite resilient during this recent period of stress. Early reports from the first quarter of 2023 indicate that first quarter aggregate bank net income was roughly unchanged compared to the fourth quarter, excluding the effects on acquirers' incomes of their acquisitions of failing banks. In addition, asset quality metrics remain favorable, and the industry remains well capitalized. Recent declines in medium and long-term interest rates have reduced somewhat the volume of unrealized losses on securities. Still, insured depository institutions will continue to face significant challenges in the near term. Risks to the outlook include the potential for weakening credit quality and profitability that could result in further tightening of loan underwriting, slower loan growth, and higher provision expenses. commercial real estate loan portfolios, particularly loans backed by office properties, face challenges should demand for office space remain weak and property values continue to soften. The FDIC continues to monitor liquidity closely, including deposit trends across the banking industry, and will publicly release data for the first quarter of this year as part of its quarterly banking profile later this month. Last week, the FDIC Board of Directors approved a notice of proposed rulemaking providing for the special assessment required by law to recover the loss to the Deposit Insurance Fund attributable to covering the uninsured deposits of Silicon Valley Bank and Signature Bank. Under that proposed rule, the FDIC would apply an annual special assessment rate of about 12.5 basis points to an assessment base that would equal an insured institution's estimated uninsured deposits, reported as of December 31st, 2022. The assessment is defined in such a way that no banking organizations with total assets under $5 billion would be subject to the special assessment. On May 1st, the California Department of Financial Protection and Innovation appointed the FDIC as receiver for First Republic Bank. The FDIC was able to market and sell First Republic concurrently with its closure by entering into a purchase and assumption agreement with J.P. Morgan Chase, following a competitive bidding process to assume all of the deposits and substantially all of the assets of First Republic. The FDIC estimates that the failure of First Republic will cost the Deposit Insurance Fund about $13 billion. Notwithstanding the 3 recent bank failures, the FDIC currently expects that the Deposit Insurance Fund will remain on track to meet its statutory reserve ratio by September 30th, 2028, without further adjustments to assessments. The FDIC recently released 2 reports on the FDIC's supervision of Signature Bank and on options for deposit insurance reform. The report on Signature Bank, conducted by the FDIC's Chief Risk Officer, found that the root cause of Signature's failure was poor management, but also identified areas where the FDIC's supervisory efforts could have been more timely, forward-looking, and forceful, findings that will be matters of close attention by the FDIC. The report on options for deposit insurance reform identified increased targeted coverage for business payment accounts as capturing many of the financial stability benefits of expanded coverage while mitigating the moral hazard effects. Finally, the failures of Silicon Valley Bank and Signature Bank demonstrate the implications that banks with assets of $100 billion or more can have for financial stability. The prudential regulation and supervision of these institutions merit additional attention, particularly with respect to capital, liquidity, and interest rate risk. My prepared testimony goes into all of these issues in considerable detail. The FDIC remains committed to engaging with the public, industry stakeholders, and members of Congress on the policies and priorities outlined in the testimony. That concludes my statement. I'd be glad to respond to questions.
Thank you, Mr. Grimberg. Mr. Sue.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, I'm pleased to appear today to offer my observations about the recent market stress and to answer any questions you may have regarding the activities and priorities of the OCC. Since March, I have worked especially closely with my peers at the other banking agencies to maintain financial stability and confidence in the banking system. Adequate levels of capital going into the recent turmoil have helped to limit the risk of contagion. Despite the market stress, the federal banking system has remained resilient, and national banks and federal savings associations have remained well-positioned to serve their customers. None of the 4 large banks that failed were regulated by the OCC. Notwithstanding, we are closely monitoring the conditions of the institutions we supervise and working with them to ensure that their liquidity and capital positions remain sound, and that they are on the balls of their feet with regard to risk management. Many have taken steps to reduce risk in light of market conditions. To date, the vast majority of OCC-supervised banks have not experienced stress with regards to their depositors or business customers. Over the past 2 years, I have consistently emphasized to bankers the importance of guarding against complacency and having strong risk management policies and practices in place. Most OCC-supervised banks have heeded this message and successfully navigated the rise in interest rates and changing economic outlook. OCC examiners will continue to actively monitor market conditions and engage with banks to help ensure that they are prepared to meet future challenges. Based on my perspective as acting comptroller and 20 years of experience as a financial regulator, I want to share some observations on steps that can be taken to restore full confidence in the banking system. First, supervisors need support to act in a timely and effective manner. Supervisors at the OCC and the other banking agencies play a critical role in keeping the banking system safe and sound by exercising discretion. The degree to which supervisors feel empowered to exercise that discretion impacts their will to act in a timely and forceful manner. Clear support to empower supervisors to exercise discretion and act when needed will help keep the banking system safe and sound. Second, regulations regarding the resilience and resolvability of large banks need to be strengthened. Stronger resiliency requirements for large banks with regards to capital liquidity would have reduced the probability of recent bank failures. Stronger resolvability requirements would have facilitated orderly failures with less government involvement. The OCC is working closely with the Federal Reserve and FDIC to address these issues. Third, deposit insurance coverage should be updated. The FDIC's recent report on deposit insurance is worth careful consideration, especially its conclusion regarding targeted expansion. In the meantime, we have been working with our banks, especially those with significant levels of uninsured deposits, to ensure that their cash holdings and borrowing capacity can meet depositor withdrawals. We remain committed to supervising banks so that depositors can rest assured that their money is safe. Finally, the diversity of the banking system must be preserved as the industry evolves. The OCC has been working on updating the analytical frameworks related to the bank merger guidelines that the federal banking agencies and DOJ must follow when considering bank mergers. The recent turmoil has increased the urgency of these efforts. The OCC is committed to being open-minded when considering merger proposals, to acting in a timely manner on applications consistent with the requirements of the Bank Merger Act. As the industry evolves, I believe strongly that we must preserve the diversity of the banking system, from community banks to mid-sized banks to regional banks. Going forward, continued industry and regulatory vigilance is critical. Banks and supervisors must be attentive to the most salient risks today, as well as those beyond the daily headlines. That will help ensure that the banking system remains a source of strength to the U.S. economy. Thank you. I'd be happy to answer any questions.
We'll now recognize Chairman Harper for 5 minutes.
Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for the invitation. My written testimony outlines the state of the credit union industry, some of the NCUA's recent efforts to strengthen the system, and several legislative requests. So I will focus here on only a few key issues. Overall, the performance of federally insured credit unions remains stable. Total loans, assets, insured shares, and deposits all increased during the last year. The system's aggregate net worth ratio also rose to 10.75%, representing a recovery of 73 basis points from its pandemic low. What's more, 91% of total share deposits within the system are insured. That has contributed to stability within the credit union sector in recent months. The NCUA's Share Insurance Fund also continues to perform well. Although the fund's equity ratio is 3 basis points below the desired operating level, no premiums are expected at this time. That's because the system is currently well-positioned to handle any dislocation resulting from a moderate recession. Nevertheless, during the last year, we have experienced growing interest rate and liquidity risks within the system, including at several billion-dollar-plus institutions. Aggregate cash positions have declined and are below pre-pandemic levels as well. Further, unrealized losses in securities limit their utility as a source of liquidity. The recent increase in these risks underscores the value of the NCUA's Central Liquidity Facility. Otherwise known as the CLF, the facility acts as a shock absorber to contain or avert liquidity crises before they escalate. However, with the termination of the temporary CLF statutory enhancements last December, more than 3,000 credit unions with less than $250 million in assets lost access to the CLF, contracting the facility's capacity by almost $10 billion. With risks rising within the financial system and at individual credit unions, now is not the time to cut a liquidity lifeline. As such, the NCUA board fully supports restoring the ability of corporate credit unions to serve as a CLF agent on behalf of a subset of their members. Notably, the Congressional Budget Office has scored this at no cost to the taxpayer. Additionally, with increased concentration, intensifying cyber threats, and greater outsourcing of core business functions, the Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's Inspector General have all recommended congressional action to restore the NCUA's statutory examination authority over third-party vendors. I fully agree and respectfully request that Congress close this growing regulatory blind spot. Lastly, the NCUA defers to Congress on determining what statutory changes, if any, should be made to deposit insurance coverage levels and account types. But if Congress does act in this area, the NCUA has two requests. First, we ask that Congress maintain parity between the share insurance coverage provided by the NCUA and the deposit insurance coverage provided by the FDIC. And second, because an expansion in coverage will generally increase resolution costs, the NCUA requests greater flexibility for administering the share insurance fund. This flexibility, which would be more in line with the FDIC's current administrative powers, includes allowing the NCUA board to establish a higher normal operating level and modifying the current limitations on assessing premiums. Together, these changes would better enable the NCUA to build reserves during economic upturns so that sufficient money is available during economic downturns. In sum, the credit union system currently remains well capitalized, stable, and well positioned to handle a relatively broad range of economic outcomes. And the NCUA stands ready to respond to any economic uncertainty and will continue to work through the supervisory process with individual credit unions experiencing problems. Consumers, therefore, should remain confident that their insured share deposits at federally insured credit unions are safe. And the NCUA stands ready to work with Congress on any legislative reforms to safeguard and strengthen the system. Thank you again. I look forward to your questions.
Thank you. I want to thank the panel for their testimony. Without objection, each of your written statements will be made part of the record. And I now recognize myself for 5 minutes. Vice Chair Barr, you created a report. Your supervisory staff reviewed the decisions of the supervisory staff in responding to these bank failures. What was the directive you gave to staff?
I asked staff who are not involved in the supervision of SVB to look at what went wrong. I told them that they would have full access to any materials they needed to make that assessment. I gave them full discretion to find the facts.
Will you provide those same materials to the ranking member and I?
We have been working with your staff on a cooperative basis to provide materials, and we're
It doesn't feel cooperative quite yet, but we'll follow up on that. And so you're saying yes, you'll provide those internal documents?
We'd be happy to continue to provide those documents. We've been providing them on an ongoing basis to committee staff.
Okay, so how did you select the staff?
The lead staff person for the report is the former head of New York Supervision, the Federal Reserve Bank of New York Supervision, who has
What divisions were involved in that?
more than 25 years of experience, and he assembled a team from throughout the system other than the San Francisco Fed.
So how many staffers worked on this report?
I'm sorry, sir?
How many staffers worked on this report?
Approximately 20.
Okay, from what divisions?
From throughout the board and system supervision other than the San Francisco Fed.
So and it was New York Fed involved? Were other reserve banks involved?
Yes, reserve banks and the board staff were involved in the report.
Okay, so given that 2 of the 3 bank failures occurred under the San Francisco Fed's purview, is there a specific review of the San Francisco Fed supervision?
We were reviewing Silicon Valley Bank. The other banks that failed were not subject to Federal Reserve supervision. Neither of those were part of our report. We were reviewing our supervision of Silicon Valley Bank only.
So in light of that, did the board vote on this report? Did you give the board a review of your report?
No, it is a report of the Vice Chair for Supervision under my statutory authorities. It was not a report of the board.
And it was provided to the board?
The Chair and other board members were given a
Okay.
copy of it in advance.
So this is not something that the board would vote on?
Correct.
But other supervisory matters are taken to the board for a board vote?
It depends on the nature of the supervisory action. Daily course kinds of examination work and so on don't rise up to that level. But if there's a formal enforcement action, for example, that would go to the board for a vote.
So in your report, you talk about a cultural shift in supervision. How did you ascertain that there's a cultural shift?
The staff, as part of this review, spoke with the supervisors involved in this and with others in the system. And one aspect of one of the 4 findings of the report was that there was a shift in the tone of supervision.
Is that done through like an opinion survey of staff?
There was no survey. It was a set of interviews that were conducted as part of the report.
Okay. So you opine that there is a cultural change, and this is based off of a few interviews from a few staff from San Francisco Fed in light of Silicon Valley Bank. And so you report that there's a cultural change in supervision across the Federal Reserve in light of just this one regional bank. That's the conclusion you draw in your report.
The report's findings are solely related to Silicon Valley Bank. That is, the findings...
But you opine that there's a general cultural shift on supervision, and it was one of the key talking points out of the report. Does this mean that supervisors were felt impeded from reporting up that there was a problem at a bank?
The report found that supervisors were more reluctant than they had been to escalate issues, yes.
Do they actually show up in the bank? Is that a bit of the problem, too? That the cultural shift could be that they're not in the banks on a regular basis, that there's more... Could that be a part of the cultural shift?
One of the findings of the report is that the pandemic contributed to a reduction in supervisory intensity. That is a finding of the report.
We'd like to hear how you're going to remedy this, and we'll have ongoing questions about this. Obviously, in light of the tightness in the credit markets, your additional capital requirements, we're going to have a lot more questions about that holistic review of capital. With that, recognize the ranking member for 5 minutes.
Well, thank you, Mr. Chairman. Vice Chair Barr, while Republicans try to downplay any role that deregulation played with these regional bank failures, I was pleased when one of their witnesses at last week's hearing, Ms. Margaret Tyre, conceded that there were regulatory improvements that should be considered. She commended the Fed's report on SVB's failure, and she specifically stated her support for 2 recommendations to address issues that were identified by the report. Number 1, eliminating the delay when enhanced prudential requirements took effect after banks crossed the $100 billion threshold. Number 2, eliminating the bank opt-out from holding capital regarding their accumulated other comprehensive income, or AOCI, which includes a bank's securities portfolios with unrealized losses. So, Vice Chair Barr, do you agree with these recommendations? Would you explain how this AOCI issue artificially inflates SVB's capital levels, making them appear safer than they really were?
Thank you very much, Ranking Member Waters. I'll speak to each of those in turn. With respect to the issue of other comprehensive income, this is basically a question of whether gains and losses on available for sale securities should flow through to the capital treatment of a bank. the initial rules that the Federal Reserve had in place applied those rules to a broader set of firms beginning in 2013. That was narrowed to just being the GSIBs in 2019. And the question is, what's the right way of addressing that going forward? We're carefully considering making a change for firms over $100 billion that would pass that unrealized loss or gain through to the capital treatment to more accurately reflect their financial condition. Any such rule change that we propose would go through normal notice and comment and rulemaking and would have an appropriate transition period for implementation. I also agree with the second issue you raised, which is about how to think about applying the heightened standards when a firm crosses a threshold. So, for example, in this case, with respect to SVB, the Federal Reserve's transition rules were themselves very complicated. And there was discussion among staff, supervisory staff, as well as the bank, about when those rules would actually apply. And the effect of that was there was a significant delay in when enhanced prudential standards applied to the firm, even under the tailoring approach. And that complexity and delay contributed, I think, to having weaker standards applied to the firm. So we are quite focused on simplifying the transition rules and making sure that firms, when they cross that threshold, are able to be ready to apply those thresholds, those new standards, when they cross the threshold.
Thank you very much. What you're referring to is basically how 2155 was crafted. And I want to know how much flexibility did you have in dealing with the deregulatory 2155 legislation?
The Federal Reserve has the discretion we need to change the approach we're using for firms over $100 billion in size. There is authority under the statute for us to make those changes, and we intend to use that authority as appropriate to make adjustments to our supervisory framework.
So you're indicating that you don't need additional legislation to do that?
That is correct.
And you agree with what has been said by Ms. Tyree? In essence, there's a need for us to deal with the whole issue of deregulation.
I do think it's important for us to look at the tiering approach that had been used for institutions of this size, given what we just experienced with a Fed supervised institution, two FDIC supervised institutions. These institutions had lower standards applied to them, and so I think it's important for us to look at that and to see what changes need to be made.
So are you looking at that now with our regionals, and particularly our small regionals?
We're looking at firms, generally speaking, of $100 billion and above with respect to these changes.
That have reached that level already?
I'm sorry?
100 billion and above.
Correct.
Thank you. I yield back.
The Vice Chair, Mr. Hill, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I think and I want to thank the panel for the engagement with the committee and for your work with each of us on both sides of the aisle over the last few weeks in light of these recent failures. Before I get to my questions, I think picking up where the ranking member left off is absolutely ideal in discussing the S2155 and a lot of argument in this city that somehow it was a contributing factor to the failure of Silicon Valley Bank and potentially others. I think that argument just falls on its face. I base that on not only my work here in the Congress, but 40 years of being involved in regulated institutions. It's just a talking point, not a material assessment, and Vice Chair Barr has absolutely just simply demonstrated to the whole committee precisely why that argument is not accurate, which is the supervision of our financial system rests in the hands of these agencies, and they have full discretion to use their best judgment to deliver that supervision on a daily basis, whether it's in a particular regional bank in California or in a macro basis. And the Vice Chairman says the statute has the authority that facilitates the proper execute of their statutory obligations, notwithstanding the modest reforms to Dodd-Frank that S2155 sought to make. And we shouldn't throw the baby out of the bathwater on this issue about tailoring, because one of the complaints on both sides of the aisle about Dodd-Frank was it was one size fits all. And it did not tailor the capital, liquidity, and leverage requirements based on bank size, and more importantly, the risk profile of the bank. Here, Silicon Valley is a large institution, but its risk profile was what was, I think, shocking when we look at the facts. So, bottom line is, we have real diversity in banking in our country. This is a strength. It differentiates our banking system from those around the world, and we need to preserve and enhance the diversity and strength of our banking system. Crisis politics trying to return to one-size-fits-all approaches to prudential regulation, in my view, will just exacerbate this challenge and make it harder to have a broad, diverse system. So, in my view, it wasn't S2155 or passing legislation, not passing that legislation would have anyway prevented this. It was clearly a failure of supervision and management. So let me turn to look at a couple of areas of interest. First, Comptroller Sue, you talked about having management up on the balls of their feet, assessing the marketplace. How do we have a sense of urgency among supervisors where they're up on the balls of their feet, which clearly they weren't in the case of particular Silicon Valley?
So we have been on the balls of our feet. And at the OCC, every year we issue a semi-annual risk perspectives report, which highlights key risks that bankers, examiners should heed. And that that report covers many of the risks that have been discussed in these hearings, as well as in the reports issued by the Fed and the FDIC.
Thank you. I appreciate that. Looking at reconciliation of these institutions, Chairman Grunberg, let me talk to you about source of strength. Holding companies deliver a major source of strength to the deposit in their depository institutions, right?
Yes, sir.
And we take that for granted to some degree. Is that true? That we just accept that holding company's there?
Well, not all institutions, as you know, have holding companies.
Right.
But the system is set up for those that do, that holding companies expect.
Silicon Valley had a holding company?
It did.
Do you have an written agreement that holding company provides source of strength to the depository bank?
Well, we were not the supervisor of Silicon Valley, and the Fed, as you know, is the holding company regulator, so I think that'd be...
No, but don't you have to have, as the FDIC, a written agreement with that bank holding company to provide a source of strength to the bank?
I believe that's a regulatory standard, Congressman, not something that we would, have some sort of...
Well, can you provide me a yes or no, just in
Sure.
writing, whether you had a written, you and the Federal Reserve have a written supervisory agreement that the holding company of all the banks that have over 50% of their deposits in uninsured accounts, that they have a written agreement with the holding company, if they have a holding company, to be a supervisor?
Be glad to.
Yep, thank you. Appreciate it. Yield back.
The gentlewoman from New York, Mrs. Velasquez, is now recognized for 5 minutes.
Thank you, Mr. Chairman. As all four of you are aware, Senator Van Hollen and I recently wrote to each of you regarding your rulemaking responsibilities under Section 956 of Dodd-Frank. Vice Chair Barr and Acting Controller Sue, I'm still awaiting your responses. And Chairman Harper and Chairman Gruber, I found your responses a little lacking. So let me ask each of you directly, since the fall of Silicon Valley and Signature Banks, what steps have each of your agencies taken to finalize this rule? Have your agencies met with one another and the other regulators? And do you think the rule will be finalized by the end of the year? Mr. Barr.
The agencies have met to discuss how to make progress on Section 956 rulemaking.
Have you met with each other?
Yes, I'm sorry. The agencies together have
Okay.
met to discuss that matter. In terms of timing, the rule would need to go through a a proposal and then
I
a final
know,
rulemaking.
I know. It has been 11 years already, 11 years. So, Mr. Grunberg,
Yes, Congresswoman. As you know, there are 6 agencies involved in this rulemaking, the 4 that are represented at the
Yes.
table here, plus the SEC and FHFA. I believe there is a strong commitment across the 6 agencies from the principal level on down to follow through and implement this rulemaking. Staffs of all 6 agencies have been meeting regularly, and I think there's a commitment to follow through on this. You know, as you point out, the NPR was outstanding since 2016. So given the time that's passed, we will probably have to repropose an NPR and then follow through with the rulemaking. So I think it's realistic to believe we can get an NPR done this year. I don't know that we can get to the final rule this year, but I believe there's
Okay.
a strong commitment across the 6 agencies to get.
well, let me just say this. We cannot wait 11 more years and see more bank failures before you actually do something. And I'm not kidding. You know, write the rule. Chair Grunberg, on April 3rd, the FDIC issued a press release regarding the upcoming sale of Signature Bank's loan portfolio in New York City, which includes a pool of single-family and multifamily properties. As you know, the FDIC has a statutory obligation to maximize the preservation of affordable housing for LMI individuals. How is the FDIC working to meet this obligation in this sale?
Thank you for that question, Congresswoman. This is something I addressed in my written testimony. And as you may know, the FDIC has been working closely with New York City and New York State, as well as with local community organizations on the disposition of this very large portfolio of multifamily housing. We're actually meeting with the city and state on a weekly basis and regularly with the interested community organizations to assure a disposition of these properties in a way that'll be sustainable and maintain the housing in good condition for the residents and serve well the local communities where those properties are located. So this is a key priority for us. We'd be glad to follow up with you and work with you in regard to it.
Great. It will be a travesty that hardworking families in New York City and other places who are facing an affordable housing crisis will lose on this one. Vice Chair Barr, I have been investigating the rapid speed at which Silicon Valley Bank grew in size and complexity, and I'm considering legislation on this issue. The Fed's report stated a similar concern. How is the Fed considering reforming its supervisory framework to ensure that as a bank grows in size and complexity, particularly over a short time, heightened regulatory and supervisory standards are applied more quickly?
You raise an important point, and we are looking at the tiering framework we have to see whether it should be adjusted, both with respect to regulation and supervision. And part of that is making sure that we don't just focus on asset size as part of that change. We want to look at risk factors such as the one you identified.
I yield back. Thank you.
The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. And I want to thank our panel of witnesses. It's not your first time to be here. We hope you do well enough to get invited back. We appreciate your feedback. It's my understanding all 4 of you were nominated and appointed by the President of the United States. Is that correct?
Yes, sir.
Let the record reflect all 4 were. The organizations which you subscribe to, going up to either the Fed or the Treasury, at the highest level of those 2 organizations, they described what lay ahead for America as transitory. Things were not going to get worse. America was going to go back to work. We were going to not have inflation. Yet something happened. Why are you trying to say that supervisors made a mistake when they were listening to, in essence, their boss's boss's boss to say, this is not a problem? transitory inflation and the problems which you're having, why do we now turn around later and act like, well, the supervisors made a mistake not following up with the bank, and the bank made a mistake because even though they were listening to the Fed and to the Treasury Secretary, this isn't going to happen. Why are you now holding them, Mr. Berry, responsible when you said, well, one of the 4 things that happened that were takeaways were supervisors saw the problem and they did not follow up properly? Who are they supposed to listen to if everybody up and down that line says everything is okay? It's only those darn Republicans or history that say we're wrong, but we're right. Why are we now dumping on supervisors?
Thank you, Mr. Sessions. The report is looking honestly and frankly at the way in which the bank managed interest rate and liquidity risks and the way that supervisors assess that. We expect, as part of our supervisory expectations for banks, that they manage their interest rate risk, whether that's in a falling environment or in a rising environment.
But the highest level of financial integrity comes from the Fed and the Treasury Secretary. They were arguing against what you just said, this factor. So is that really why they didn't follow up? Because they said it, but we know that's not going to happen? I mean, you've got to, at some point, somebody's got to accept the responsibility that they were misled at the top of your organization. And officially in front of this Financial Services Committee, we were told repeatedly, that's not going to happen, transitory, not going to happen, everything is okay, you guys were overstating it, and now you come and blame them.
Let me just say the essential facts. I joined the Federal Reserve Board in July 2022 at a time when the Federal Reserve was clearly raising interest rates and had been raising interest rates for some time. My understanding, this is before my time on the board, was that it was quite clear from the fall of 2021 that interest rates were going to go up. The bank decided to, during this period when the Federal Reserve was already raising interest rates and had said that they were going to continue to raise interest rates, the bank decided to remove its interest rate hedges that protected it from a rising interest rate environment. So I think the findings are clear on that point.
Well, I remain skeptical, and I know that I've heard the testimony today. Everything is okay. We've gone back and double looked at everything. Nothing bad is going to happen. It's all taken care of. My point would be, I think somebody needs to accept the blame, and that is that the advice that they were given from the very top of the organization was it was not transitory, and I failed to see that in this report. I failed to see that the advice given from the very top was in fact incorrect, and some of the down management decision-making, including boards, was they made decisions based upon the top of the deck. So I don't want it, I'm not crying over spilled milk. I'm crying over that there should have been some history to understand if you raise spending $3 trillion and then do what has happened out of Treasury, you're going to have a problem. Mr. Chairman, I want to thank you all for being here.
Gentleman's time.
Mr. Chairman, I yield back my time.
Gentleman from California, Mr. Sherman is now recognized for 5 minutes.
Mr. Harper, I agree with you. We need parity for credit unions, both as to the level of depositor insurance and as to access to liquidity facilities. The banks are not doing what we need them to do. We need them to make business loans. We don't need them to buy treasury bills. Everybody in the world will do that. Yet less than 15% of bank investments are in business loans. They're buying marketable securities, they're buying mortgages. We have a good system for financing corporate bonds. We have a good system for financing marketable securities. Part of this, a big part of it, is our accounting system and the system for regulating banks. Under the CECL system, we penalize every bank every time they make a good business loan on the day they make the loan. Profits go down. And under our non-recognition of unrealized losses system, for the most part, we tell every bank officer, if you invest in marketable securities and they go down in value, it's easy to hide the loss and it doesn't count against your income. You keep your bonus. And if those marketable securities go up, you can sell them at a profit, increase the profits of the bank, and your bonus goes up. So why would anybody make business loans when the way to maximize bonuses is to invest in marketable securities? The chair, perhaps unfortunately, wanted to say that this is a problem created by Democrats. Yes, we've had inflation recently. Almost all the spending has been bipartisan due to the COVID crisis. There was one Democratic bill that spent $2 trillion that was not bipartisan. And there was one Republican tax bill that cut revenues by $2 trillion that was not bipartisan. I would say that it is better to have spent $2 trillion helping people in desperate need from COVID effects than spend $2 trillion subsidizing billionaires. But the big issue here for us is how do we have a banking system strong enough so that it can survive interest rates going up and interest rates going down? Because you know what? Interest rates go up, interest rates go down. And this is not a 100-year event. We had 16% interest rates back when I had hair, and we'll have 16% interest rates hopefully before, or I hope we don't have 16, but interest rates go up, interest rates go down. We passed a strong standards with Dodd-Frank. We weakened those standards precisely when the Republican bill weakened the standards for $100 billion to $250 billion institutions, and those are the exact institutions that have this problem. And the regulators actually implemented the law the way it was intended to be implemented, which was to deregulate and non-stress test these medium-sized banks. So now we say we blame them because they did what the Republican Congress told them to do. And particularly pernicious about that bill in 2018 was it was wrapped in veterans' benefits so as to force or trick some members into voting for it for that reason. It never went through a real committee process. Mr. Barr, banks can avoid a good part of the oversight simply by not having a holding company. Should we have a loophole where you can structure your bank differently and choose what level of regulation you're going to have?
I think it's important for the system to have an approach where the same risks and the same institutional structures are governed by the same kind of supervision and regulation. So not having a holding company as an additional layer of protection so that you can see across all activities of affiliated entities, I think is a concern.
We would not have designed our system this way with so many different regulators. Pick your regulator. I wish I could have picked my IRS department. When I filed my return, I would have picked the one that would have been less rigorous on me. I'm going to ask the bank regulators, now that we've seen what happened this spring, are we being more vigorous in looking at interest rate risk, and are we requiring banks to take prompt corrective action when they face those risks?
I think the answer to that, Congressman, is yes. I think interest rate risk management is probably job one right now from a supervisory standpoint.
Panel can respond for the record. We'll now recognize Mr. Posey for 5 minutes.
Thank you, Mr. Chairman. Vice Chairman Barr, Barron estimated that the undeclared loss on Silicon Valley's bonds due to the rapid run-up in interest rates starting in March 2022 would have wiped out nearly all the bank's $16 billion equity capital base at the year end of 2023. Two of our witnesses at our May 4th hearing said that the regulatory capital wasn't the problem and that the bank was well capitalized. Do you agree with that statement?
The bank was well capitalized under a standard that omitted the pass-through of gains and losses on available for sale securities. So I would say that the bank did have solvency issues. The bank was well capitalized under our existing rules, but those rules permitted them to opt out of the AOCI pass-through. If they had to record that pass-through, the capital impact would have been $2 billion. Because the depositors saw the solvency of the firm as a concern, that is why they ran. So I do think both solvency and liquidity risks are intertwined in this case.
One of our previous witnesses also said that it's particularly hard to understand why the Federal Reserve failed to regulate interest rate risk when it was the Federal Reserve's monetary policy that created the risk. The Federal Reserve was raising interest rates for nearly a year before the wave of banks' distress set in. Was there a breakdown in communications or strategy between the monetary policy and the supervision wing of the Federal Reserve?
In this case, what the report found is that supervisors identified that there were interest rate problems at the bank. For example, the bank had an interest rate stress model that was not appropriately showing the actual interest rate stress that the firm was experiencing, and called that out to the firm. So there was not a problem in identifying that risk, but the firm did not take action promptly enough to fix the interest rate issues before it failed. In fact, it ended up doing the opposite. As I mentioned, it took off interest rate risk hedges in March through July of 2022 at a time when rates were rising that would have helped protect it from some of the risks of those rising interest rates.
What did the Federal Open Market Committee do to identify interest rate risk as a likely outcome of their monetary policy and to alert the supervisors to remain vigilant?
The Federal Reserve was quite attentive to interest rate risks. Really, it's a core part of supervision. Interest rate risk and liquidity risk are kind of bread and butter issues in bank supervision. Those were intensified during 2022. As interest rates were rising, supervisors were told and did engage in more aggressive looks at interest rate risk in the banking system. And those efforts, as it turned out with respect to Silicon Valley Bank, did not result in the bank changing its behavior. As I said, the bank was really undoing some of the protection that it actually had and not taking steps to protect itself from that risk. They were doing the same on the liquidity side. Instead of looking at their liquidity risk, and when they found a problem with their liquidity stress testing, they changed the test to make it less conservative. So it would seem like the measured risk to the bank was lower when the actual risk was higher. So those are the kinds of things the bank was engaging in that were really the opposite of what you'd want a bank to do when it's facing interest rate and liquidity risk.
Thank you. Did the Federal Open Market Committee issue any communications to bank supervisors related to the likely impending interest rate risk, and what are some examples if they did?
The Federal Reserve made it clear, the FOMC made it clear in the fall of 2021 that interest rates were going to need to rise. There would be quantitative tightening going on in terms of shrinking the balance sheet. And as I mentioned, supervisors throughout 2022 were focused on interest rate risk as one of the bread and butter issues to address, along with liquidity risk and, as some of my colleagues had mentioned, issues with respect to credit risk, particularly in the commercial real estate space.
Thank you, Mr. Chair. My time is about to expire. I yield back.
All right, microphone's not working here. Great technology. We'll now recognize the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Chair Gruenberg, in your May 1st report outlining options for deposit insurance reform, I actually was pleased to see that the FDIC favored targeted coverage for business payment accounts. As you said in your written report, targeted coverage captures many of the financial stability benefits of expanded coverage while mitigating many of the undesirable consequences. And one of the things that's been on my mind for some time is whether or not we should bifurcate it or have a tiered system of insurance to create different categories for individuals and small businesses, which we discussed, I think it was the last time that you testified before us. So the big question is, because with these businesses, if they can't pay, it's going to make damaging to our economy, is what is the appropriate level of deposit insurance for business payment accounts, and how would it be paid for? What do you think?
Thank you, Congressman. It's an important question that we need to think through. First, it would require a legislative change to increase deposit insurance coverage for business payment accounts. And as we indicated and you noted in our report, of the options available, we thought that was the one that perhaps made the most sense because it addresses a potential financial stability risk with these accounts, but the moral hazard is really limited because these accounts are business payment accounts where you can't utilize them across multiple banks, but you really keep them in one institution in order for the operational convenience of the payment account. I think the decision, if the decision is made to increase coverage for this targeted purpose account, is really a judgment how high to go, and realizing the higher the coverage, the higher the assessment cost will be for the industry. So I think that's a balancing judgment that would go into the consideration of any legislation that might be needed to do this.
And I'd like to, at some point later, to discuss with you some thoughts that you have on what role the FDIC could play in helping us think through it as members of Congress. Let me go to Vice Chair Barr real quick. You have been steadfast in your remarks that the banking system remains strong and resilient. While much of the focus has been on the large regional banks, I want to discuss briefly the vibrancy of our community banks. Especially, what I'm passionate about is our MDIs and our CDFIs. And they play a huge role, as far as I'm concerned, in both rural and urban areas. So what I'm concerned about is it's common for the large regional banks to make investments and deposits into the community institutions. So in your estimation, will the recent bank failures and associated special assessments have, for lack of a better word, a trickle-down impact on community banks? And should we begin to brace for something happening to community banks as a result?
Thank you, Congressman. I share your view that community banks are sound and resilient. They're providing essential services to communities across the country, including the community banks that are CDFIs and MDIs. They are disproportionately responsible for investing in and supporting small business lending and local communities. So they just absolutely vibrant part of our banking system, and one that all of us fully support. The community banks, I know many members have said this to me too, you're hearing it in your districts. Community banks are doing well in serving their communities, but are concerned about the broader ramifications of the economic situation and the banking stress. It's something we're quite attentive to. We want to make sure that we have a diverse range of financial institutions in our economy, small institutions, regional institutions, large institutions. And so we're quite attentive to that in this current environment, making sure that the problems don't affect their ability to lend.
I have 10 seconds, and I'm hoping that you will have a holistic review of the capital framework and take into consideration the ability or willingness of these investments from those larger banks because of these fees.
Gentleman's time has expired. We'll now recognize the gentleman from Missouri, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman, and thank the witnesses for being here today. Mr. Barr, In your own report, you say that the Federal Reserve did not take sufficient steps to ensure Silicon Valley fixed its problems. You indicated again this morning the Fed didn't take sufficient actions. Just a minute ago, you made the comment to my colleague here, Mr. Posey, that one of the core responsibilities of an examiner is to review interest rate risk and liquidity risk. What happened?
Thank you, Congressman. The report found that the interest rate and liquidity risks were identified by supervisors. They called attention to the things like changing the test on ILST.
Mr. Barr, it's well documented in the GAO study that I'm referring to here that you that you continuously monitored the situation, excuse me, and found numbers of times the problems with liquidity and interest rate risk. Why didn't you do something? Why didn't your examiners do something about it?
No, I think that's exactly right. What the report found is that risks were identified, but supervisors did not escalate concern about those issues promptly enough and not forcefully enough. And that's one of the reasons why we need to really look internally at our own system of oversight and improve
I appreciate that comment. I'm sure that you guys fired the management team of Silicon Valley when you went in and replaced them, told them get lost. Has anybody at the Fed lost their job yet as a result of this? Since it was a core responsibility of the examiners to do interest rate risk reviews and liquidity risks and did nothing about it.
The report found that they acted on it, but they did not escalate it sufficiently to change.
Is anybody going to lose their job, Mr. Barr, because they were incompetent in doing their job?
We're looking across the system at our system of supervision. We want to make sure we have the right personnel in place.
So the answer is no.
Responsible for doing
Okay,
that.
Mr. Grunberg, apologize for my voice this morning here. In the same GAO report, your agency took a hit as well with regards to Signature Bank. Management failed to take adequate steps to mitigate the bank's longstanding liquidity and management issues before the bank's failure. FDIC lacked urgency despite seeing that Signature Bank's repeated failures. And when Signature Bank failed to do what you asked them to do, you did nothing. Tell me how this happens.
Yeah, no, Congressman, I think that's the core issue here, and it's a certain degree common in both of these. The examiners identified the issues. They provided supervisory guidance and direction. We had an institution here, unlike most banks, quite frankly, that are quite responsive to guidance from supervisors. In the case of this institution, they were not. And I think the core issue was the failure on the part of examiners to compel compliance. When issues were identified, guidance was given, and they were not addressed over a period of time.
Let me interject here. As a former examiner, whenever you see that these two banks were outliers significantly from the rest of the banking industry, and you're sitting there letting them continue to do things that you know are dangerous, not only to themselves but to the system, it's incompetent. You can't let that continue to go on. Mr. Grunberg, is anybody at the FDIC going to lose their job over this?
We are. I think this episode requires us, as you know, our chief risk officer did an internal review in addition to the GAO report. I think it's incumbent on us to do a comprehensive review of our supervision program, including our staffing structure. Okay. We're going to have to identify deficiencies and be prepared to address
Well, I appreciate that comment. We'll see if anything happens. Hopefully by the next time you come here, we'll have some action that would have been taken that would be very prudent on how this could do. I appreciate your comment this morning, Mr. Grunberg, that the industry remains well capitalized since it seems to be a discussion about having to raise more capital. I think better supervision would be a better idea than more capital. But Mr. Barr, the Federal Reserve has got itself underwater in its own situation with this interest rate situation. Mr. Powell was here the other day, admitted he's not making any money, he's losing money because his interest rates on his investments is upside down as well. Because he's not making any money, how's he paying the bill for the CFPB? Because technically the law says he's supposed to be paying out our revenues. Since there's no revenues to pay it out, how's he paying the CFPB bill?
The CFPB is being paid in the same way that the rest of the Federal Reserve system is being paid, identically in approach.
Well, if that's the case, then they're printing money, because that was the response of Mr. Powell today. When I asked him the question, how are you paying your bills? And he said, we're printing more money. So, With that, Mr. Chairman, I yield back. Thank you.
The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you very much, Chairman. Vice Chair Barr, your Fed's recent financial stability report found a number of pressure points emerging in the commercial real estate market, correct?
Yes.
And also, you had a survey that accompanied that report, and commercial real estate was mentioned as, and I quote, a possible trigger for systemic risk, correct?
Yes, we're looking quite carefully at commercial real estate risks. Banks are an important part of that market. They're not the only part. There are lots of non-bank investors as well. But
I think what we are concerned about is the fact that these commercial risk markets represent only a small part of the total assets held by the larger bank community. However, these mortgages represent 1/5 of total assets held by our nation's smaller banks. That is what we got to be concerned about. And your own staff at the Fed wrote that the rising interest rates over the past year will increase the risk that commercial borrowers will not be able to refinance their loans when the loans reach the end of their term. Now, that is the real story of where we are. So, my first question to you is this: do you believe that smaller and regional banks have a right to be very wary of pressure related to the commercial real estate market?
I think it's important for commercial real estate risks to be well understood and mitigated by banks. Community banks and smaller regional banks are many of them more concentrated in commercial real estate than the larger banks. And so it's important for them to understand their risks and to appropriately mitigate those risks as institutions are doing.
So it is my understanding then that your office has expanded what we refer to as examination procedures for banks with significant exposure to commercial real estate. Would you say this is directly related to the sharp jump in borrowing costs over the past year?
The risks in the commercial real estate sector arise from several sources. One of those is that there are much lower vacancy rates in downtown office buildings in many cities. Because of the response to the pandemic, there are a lot fewer people in office buildings working. That's also put some pressure on retail. We're seeing some pressure in the multifamily space, especially given rising interest rates. And then rising interest rates make it harder to refinance.
Correct.
And so
my
that puts
time is
additional pressure.
moving on, and I've got to get your attention focused on this area too, affecting our low and moderate income borrowers, especially as we continue to hear about the credit tightening. So, as you conduct your holistic review of capital and long-term debt requirements, are you fully analyzing the impact this change could have for low and moderate income communities and small businesses?
We do look at the overall impact of our capital rules, including on low-income communities and on small businesses, as part of how we think about the overall effect that capital has. Right now, we are seeing with strong capital in the system, that is a place that we continue to look.
And do you anticipate that these new requirements could make it more difficult and costly for those on the margins to get a loan?
Our experience is that strong capital requirements make it possible for institutions to serve all their communities through times of stress.
Thank you, Commissioner Barr.
Now recognize the Oversight Subcommittee Chair, Mr. Heisinger, for 5 minutes.
Thank you, Mr. Chairman and witnesses. I appreciate it today. I'm going to jump right in. Mr. Grunberg, I'd like to start with you. Appreciate the cooperation so far, but I will note that anything you can do to speed up the production of the requested material from the chairman and myself would be much appreciated. I do want to dig into the bid process that the FDIC uses when they've taken a bank into receivership and look to sell it. In a recent Bloomberg article, Director McKernan has quoted as saying that, quote, the FDIC is hindering the ability of non-banks to participate in these auctions, close quote, because they are not given the same terms as bank bidders with respect to a loss share arrangements and deal financing. And I'd like to submit that for the record, Mr. Chairman, that article. Without objection, I assume, Mr. Chairman?
Without objection.
Thank you. Is Director McKernan wrong when he says that non-bank participation is, quote, really in name only?
We've made a considerable effort for all of 3 of the failed institutions.
So you believe he's wrong?
I don't, may I just answer to say that I think we've made a significant effort to invite both bank and non-bank interested parties to participate in the bidding process.
All right.
And they have.
All right. Mr. Vice Chair, Chair Barr, last week your colleagues, one of your colleagues, Governor Bowman, called for a third-party review of the actions of the Fed in connection with Silicon Valley Bank's failure. Will you commit to facilitating a third-party review of the Fed's actions?
I thought it was important for us to start with a self-assessment.
Sure. Yep.
Obviously, the
Moving
Congress,
on, though.
Congress is looking at these issues. The Inspector
Correct.
General is looking at these issues. The GAO is looking at these
So
issues.
do we count as a third party?
I don't know what Governor Bowman meant by that, but to me, you're not part of the Federal Reserve.
So so do you believe there needs to be a third-party independent review outside of the congressional review and your own internal review?
I think there are such reviews going on already.
All right. Well, will you commit to providing the committee with full access to documents and employees needed to conduct our own assessment?
We have been cooperating with your staff on that, and we'll continue to do so.
I think I will echo what I told Mr. Greenberg. Anything you can do to speed that up would be much appreciated. As the chair had quoted about this culture shift, he had noted that you had included that prominently in your report. Did you hear about these, quote, culture shift concerns prior to conducting your internal review, or was that news to you until the review?
I had heard similar reports before the staff conducted this review.
Okay. So GAO testified before my Oversight Subcommittee last week about their own review of the bank failures, and in response to a question, the GAO witness stated that, quote, no such culture shift was raised in their own interviews with Fed staff. So why are you keeping it a secret? I mean, if it's that big of a concern, why is it a secret that you're not telling the GAO about this? And in fact, the GAO's testimony confirmed that a slow escalation of supervisory concerns has been noted in their reports since 1991. 1991, not 2155. 1991. So here's what I would like to ask you. You said there was about 20 individuals that were interviewed for your internal report. Will you provide the committee with a list of those employees who you interviewed for the report?
The 20 I was mentioning in my testimony are the people who are conducting the review.
Okay.
20 staff.
So how many interviews were done for that report?
But I'd be happy to continue to work with your staff and have our staff work with them on all the requests that you've made. That's
okay. So
part of our ongoing
is that a yes? You will
cooperation
commit
with
to allowing us to identify the staff and then allowing us to speak to them?
I think that there are some trade-offs involved in that I'd like our staff to discuss with your staff.
What in the world trade-offs of what? If we're supposed to be doing, you're telling me that you're not sure whether there should be an independent third-party review, that we aren't part of the Fed, so we should be doing a review. We're trying to do the review, but you're telling us we may not be able to talk to the people that might actually have the information that would be helpful to the review.
You're as a chair of the subcommittee, you're of course welcome in the end to decide who you want to talk to and get cooperation from them.
We're getting closer. Okay.
I'm just pointing out that there's a trade-off in terms of making sure that in the future, when we do reviews, we have staff who are...
I've got one last thing. Just as we, and you, I would assume, expect management failures to be owned up to by the management, do you take full responsibility for supervisory failures at the Fed under your watch?
Yes, I do.
All right. Well, a lack of enforcement on your part does not mean a need for more regulation.
time's
It means
expired.
stronger follow-through by the regulators.
We
on
now
your
recognize
back.
Mr. Lynch of Massachusetts for 5 minutes.
Thank the chair. Chair Grunberg, I just want to start off by saying thank you on behalf of the people of Brockton, Massachusetts, for your willingness to come to Brockton and to listen to their concerns about the failure of Silicon Valley Bank and the impact that it is going to have on, could potentially have on the creation of affordable housing in that city. I can say that my constituents asked me to say thank you to you publicly and your staff for your willingness to come to Brockton. Mr. Barr, so every bank in America had to deal with rising interest rates, but Silicon Valley Bank was doing something very, very different. They concentrated on startups, VC-funded startups, so especially early-stage startups are, they're probably more prone to failure and volatility than mature businesses. SVB also, their deposits, because they went after these companies, their deposits went from $60 billion to $180 billion in 2 years. So very fast growth there. The thing that puzzles me is that they invested, they bought $91 billion in T-bills at a time when T-bills, the interest on T-bills was very, very low. So, and they were long duration. Did that contribute? Well, let me fast forward. When Mr. Powell, when Chair Powell announced for months and months and months that he was going to increase interest rates and then began to do so, that $91 billion at Silicon Valley Bank the value of those T-bills and treasuries plummeted to $21 billion. And that's when people started to pull their money out. So what was the responsibility of the Fed in light of the unwise decision on the part of the management of Silicon Valley Bank to operate in that way?
The Federal Reserve supervisors looked at these issues and found that the bank had been mismanaging its interest rate risk and its liquidity risk. It had removed hedges that would have protected it from a rising interest rate environment. It had changed its interest rate sensitivity test in order to make it less conservative. It changed its liquidity test to make it less conservative. It failed to fully understand the risk from its concentrated depositor base or the risks associated with the venture capital fund deposits. And so the supervisors pointed those out. The bank failed to correct those issues. And that's fundamental, as I've said, interest rate and liquidity risk mismanagement on the part of the bank. Where we fell down on the job was not forcing them, forcefully enough to make those changes fast enough. And that's outlined in the report.
What are the tools that you need in order? So that was the point of failure, really, where they got themselves into trouble and you could not, somebody did not compel them to change their, I'm not even sure at that point where they had lost so much money, I'm not sure what you could have done, but what are the tools that you might have availed yourself of if you had them to prevent, a total meltdown like we saw?
One example I'll cite for you is that generally speaking, at the Federal Reserve, we don't put in place immediately mitigants or incentives on a firm. So higher capital, for example, or higher liquidity, or limits on incentive compensation, or limits on capital distributions. And those kinds of tools might be appropriate in some cases where you have a firm that is not responding fast enough to significant issues at their bank. That might have made a difference here. And obviously, we're also looking more broadly structurally. This firm grew very rapidly at a time when it was subject to much lower regulatory and supervisory standards. You know, if we had in place those higher standards, the firm might have had more significant risk management infrastructure in place, stronger capital and liquidity in place. And so we're really looking across the board at both supervision and regulation to see where we might make improvements.
Okay, Mr. Chairman, my time has expired. I yield back. Thank you.
Gentleman has time to yield back. I thank the gentleman. We'll now recognize the Chair of the Capital Markets Subcommittee, Ms. Wagner, for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, when you testified before this committee in March, I asked you why the Fed had not considered escalating any of the supervisory concerns at SVB into more formal enforcement actions. Your response was that you would be looking into it. It's now been 2 months since these failures occurred, and your report has been released. So I'll ask the question again. After dozens of supervisory determinations were issued over many years that went unanswered by SVB's management, what prevented the Fed from escalating its supervisory actions against the bank, and why didn't the Fed recommend any formal enforcement actions against the bank?
That's detailed in our report. It's 114 pages, basically laying out the problem that you explicitly asked about and addressed in our last hearing. And what we found is that supervisors were essentially too timid, too slow to raise those standards in a timely enough way.
But it was years. These citations, these supervisory determinations were handed out over years.
Yeah, so
where's the management? Where's the supervision of the regulators?
So some of those issues that were identified many years ago, the bank responded to, and those issues were closed. But new issues were opened, and the bank was not timely responding to those. So it is a problem of getting our supervisory teams to be acting with more agility.
I hope there's going to be repercussions for this, because this is obviously now escalated into a much broader concern. Do you agree that escalating supervisory action should have happened sooner, sir?
Yes, it's consistent with the report's findings.
You know, based on the Fed's report and the GAO's independent review of agency actions, there is just a decades-long slow-to-act pattern that we're seeing when it comes to enforcement. It's clear that these failures could have been prevented if our regulators acted more forcefully with bank management to mitigate risk. You know, I raised 3 children, and when I told them to stop doing something, and they kept doing it, I didn't take them out for ice cream, sir. You know, I put them in timeout. They needed to have been supervised more closely, and this needed to be, action needed to be taken. Vice Chair Barr, in your SVB report, you stated, and I quote, SVB failed because of a textbook case of mismanagement by the bank, and that Federal Reserve supervisors failed to take forceful enough action. You also stated that, and again I quote, our banking system is sound and resilient, with strong capital and liquidity. Yet, instead of addressing the identified failures in a timely fashion, you somehow concluded that you need to bolster financial resiliency by layering on more regulations. For example, specifically, not just the capital requirements, but the implementation of the Basel III endgame rules. Shouldn't your first priority, sir, be ensuring existing prudential regulations are effectively enforced before layering on more regulations? And if bank regulators, supervisors, and examiners do not properly enforce existing rules, putting more rules in place does not fix anything.
I think that we need to do both. I think we need to enhance our system of supervision to make it more agile, more quick. We need to also improve our system of regulation so that we have the kind of resiliency we need with capital and liquidity in the system. We've been working together, the other regulators and I, on Basel III Endgame package since I arrived at the board in July of 2022.
It's been going on for years, decades. I mean, what I'm trying to get at, you've got to effectively enforce the rules and regulations that are on the books now, before layering on more onerous capital requirements, regulations. What analyses have you done to demonstrate that that had the Basel III Endgame rules been in place, the SVB failure would have been avoided? And will you provide those to the committee?
What we're looking at in the Basel III Endgame rule is capital resiliency for the very largest firms as a whole. We're not trying to target it to SVB.
Gentlemen, gentlelady's time has expired. We'll now recognize the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Excuse me. Thank you, Mr. Chairman. I wanted to direct my conversation to Mr. Sue and to Mr. Harper, and it won't surprise you where I'm going. In 1977, your agencies did something that I think we might not be able to have that happen now, and that is to create a Community Reinvestment Act. A lot of people think Congress created it. Congress has amended it, but Congress did not create it. And so over the past few years, we've had amendments from time to time. We haven't had anything since, I think, about 1995. And so I know all of the agencies have been working over the past few months, because I've been chatting with all of you and others about CRA. And one of the things that I'm concerned about, Graham Leach Bliley made, I think, some correction. The smaller banks would have fewer examinations for CRA exams. I have a bill, the Community Reinvestment Reform Act, that would subject independent mortgage companies to CRA exams, codify community benefit agreements, specify endowments, and create an improvement plan and require disclosure of deposits from low to moderate income communities. Is that one of the changes that you think would be compatible with the direction you're going?
Sure. Representative Cleaver, thank you for that question. Anything that can be done to strengthen and modernize the CRA would be welcome. I think that that's something that we're all committed to. And so we'd be happy to engage with your staff on the proposals that you just discussed.
Mr. Harper.
So CRA does not apply currently to credit unions, although some states have applied CRA to state-chartered credit unions.
Oh, so you don't think we could do that? Because I guess the last thing I want to do is get involved with credit unions. I've been around for a while. That's a headache I can just as soon ignore, put out of the way. But CDFIs and MDIs, which serve small businesses and communities, are feeling the pinch of tighter credit standards. And they're also feeling the pinch of their own with investors and larger banks pulling back on lending. Does this trend signal that we need a stronger incentive, such as through Community Reinvestment Act, so that banks are encouraged to make investments in those communities' financial institutions?
Sure. Yes, I'll start, and I think my colleagues will be happy to jump in. Yes, having strong MDIs and CDFIs is an important objective. I think we all agree on that. Within the proposal, the joint proposal for the CRA that was put out by the OCC, FDIC, and Fed, under the proposal, it was to improve the speed and to make it easier for banks to invest and support CDFIs and MDIs. We're in the process of finalizing that, so I can't get ahead of our finalization, but that is an objective, and we got a lot of comments on that from the public. We'll be incorporating that as we make that finalization.
You used the word comments. I know you went through the comment period, and I'm sure that all of the big banks were very kind and cooperative in their comments to your work. Am I wrong?
I think there are a range of reactions, and we're taking all of those into account as we finalize the rule.
I yield back, Mr. Chairman.
Gentleman yields back. We'll now recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you. Vice Chairman Barr, the independent GAO report concluded that the Federal Reserve identified risks and took supervisory actions, but did not adequately escalate actions prior to SVB's failure. Do you agree with that conclusion?
Yes, that's the same conclusion we reached in our own report.
Yeah, you did, and I appreciate that, and I've got your report here, and on page 8 of that report, you pointed out that SVB moved from the RBO portfolio, regional bank portfolio, to the large bank portfolio in February of 2021, approximately 2 years before Silicon Valley Bank failed. You also noted on the same page of your report that the Fed board provided the Federal Reserve of San Francisco team, the supervisors here, a waiver to delay the initial set of ratings under the large financial institution rating system by 6 months to August 2022. I think the reason why both reports are concluding that the Fed failed to adequately escalate is because the Fed itself is delaying implementation of the enhanced supervisory standards. So I don't think this is a failure of regulation. I think both reports are acknowledging that it's not regulation, that the bank was subject to enhanced regulation 2 years before the bank failed. So I do want to revisit the issue of the policy recommendations of more regulation, but I also want to ask why the report, your report, says nothing that I can see about monetary policy mistakes. Do you acknowledge that the Fed was wrong in 2021 to conclude that rapidly rising inflation was transitory?
The report is focused on the supervisory failings of the Federal Reserve.
Sure, I know that. But
staff is not.
No, wait, I know that. But do you acknowledge that the Fed should have started to normalize a monetary policy and raise interest rates earlier in light of excess fiscal stimulus and persistently high inflation?
I was not on the Federal Reserve
I know you
Board
weren't.
at the time.
I know you weren't. But I want to know why the report doesn't talk about this. The divorcing of monetary policy from supervision is a problem. Do you acknowledge that interest rate management would be easier and supervision of these institutions would have been easier had monetary policy tightening started earlier and had been implemented gradually as opposed to precipitously?
The responsibility of bank management is to take the monetary policy, the interest rate world around it, and to respond with appropriate risk metrics.
I understand that, but here's the problem. The argument for why regulation and monetary policy are both at the Fed is that it's supposed to inform each other. Supervisory policy should inform monetary policy, and the reason why the Fed has always argued that we should retain our supervisory authority is because it informs monetary policy. They're intertwined, and the failure of the Fed to acknowledge that monetary policy errors are the underlying cause of bank instability is very revealing. Let me quickly ask you on capital review, two scenarios, Vice Chair Barr. Bank one has 94% uninsured deposit. It reports $91 billion held to maturity securities with a market value of $76 billion and an unrecognized loss of $15 billion. Its cash held at the Fed represents approximately 5% of its uninsured deposits, and a single industry represents more than 50% of the institution's customer base. That's institution one. Bank number two has just 14% of its deposits uninsured. It holds 0 held to maturity securities. Approximately 93% of its liquidity is in cash held at the Fed, and that cash represents more than 100% of its uninsured deposits. The bank has a large and diverse customer base with tens of millions of individual customers and small business customers. Do you understand the differences between the banks I just described?
I think in general terms, although of course I was not following your math with precision.
Well, you generally understand the vast difference between those institutions, but they're the same size, exact same size. Do you believe these two institutions should be subject to identical bank capital regime, to an identical bank capital regime?
I think our capital regime should take, and our liquidity regime should take account of the risk profile of the firm.
That's good, because the Basel Committee on Banking Supervision does not. And so my question to you is, will you commit to deviating from the Basel recommendation that fails to tailor the capital charges for operational risk?
I'd be happy to follow up with you to discuss your concerns in greater detail.
Well, I'd like to do that because operational risk differences should inform bank capital regulatory changes.
Gentleman, time has expired. The gentleman from Illinois, Mr. Foster, is recognized.
Thank you. Acting Controller Sue, you emphasized the importance of regulatory discretion in your remarks, which is a lot of what we're wrestling with right here. And there's obviously a fine line between, regulatory discretion and, regulatory capture, which is one of the risks. And discretion, we're learning, again, can also be very dangerous if banks come to rely on discretion instead of actually solving the problem. So are there instances that you can think of where less discretion might actually be a benefit that would provide more leverage in your negotiation with a bank that's not really complying?
Thank you for the question. So ultimately, what we want and what we need is a safe and sound and fair banking system. That's the goal. The way to achieve that is through a balance of regulation and supervision in equal parts. The regulations provide clear rules of the road, clear speed limits, so to speak. Supervision, really strong supervision, entails the exercise of that discretion to know when to call out particular issues, to identify risks, to escalate them, and to act. And I think that's what a lot of the conversation has been about today. And so we have to do those both in equal parts.
But for example, if there was a rule that you had mandatory escalation whenever a bank was approaching mark-to-market insolvency due to interest rate, and instead of the way we've been not handling that, would that have been an advantage in these bank situations?
Mechanisms like that can help. I think it really depends on the context of what the issues are, but that is something that we think about internally for different types of issues within our internal policies and procedures, what fits within a particular mechanism of automatic escalation versus that which requires some judgment. It depends.
Mm-hmm. Any other comments on this from any of the other witnesses?
Congressman, the issue you describe is a constant tension, I think, in the supervisory process. I've had meetings with bankers, and I'd have one banker say, there needs to be consistency across supervisors. And I'd have another banker say, supervisors have to be able to exercise judgment in looking at my institution. And they'd both be in agreement at the same time. The comments suggest the tension, and I think that's something you sort of have to work through in the supervisory process. You obviously want consistency, but you want examiners, based on their experience, to be able to exercise judgment as well. And I think that's part of the challenge of thoughtful supervision, quite frankly.
I would just add to the conversation that I do think we need to make it clear to supervisors that they have all the tools they need to use that discretion in the appropriate place. So I mentioned the example that we generally don't use supervisory tools that we could use, limits on incentive compensation, limits on capital distributions, requiring additional capital, requiring additional liquidity, even when we see a serious issue. And we could flip the presumption.
Why do you decide not to do that?
We could flip the presumption so that those tools are more readily available to supervisors. But that is not
by default. Capital distributions and bonuses or whatever would not be allowable if you are in violation of hard and fast requirements.
So that could be an approach that provides the appropriate
might get the attention
toolbox
of the bank board and the CEOs in ways that seem to have failed here. Vice Chair Barr, could you say a little bit about the timeline you anticipate for the holistic capital review, any rule changes that might come out of this episode, and so on? How does that look? When can Congress expect to see some presentations? When do we expect preliminary and final rulemaking on all these?
Thank you. I expect this summer that we'll be able to present my thinking on this, and that the three agencies working together will be able to come forward with the Basel III endgame proposal for public comment. As I've said before, any changes here would go through the normal rulemaking. So there'd be a proposal, get public comment, then a final rule, and then a transition period for banks to come into compliance.
And I hope there'd be a role for Congress in that, in particular early on, when you've concluded the direction you want to go for these, to actually have a discussion with Congress and allow industry time to react before things are fully baked. Because, you know, this is not purely a safety and soundness thing, as I mentioned in my opening remarks. Thank you, and yield back.
Gentleman yields back. Gentleman from Ohio, Mr. Davidson is now recognized for 5 minutes.
I thank the chairman. I thank the folks that comprise the majority of our bank regulatory framework for being here today and for the attention you're giving, frankly, particularly in the wake of the failures that we're talking about today, to make sure that we do have a safe and sound system. And frankly, not just to write reports about it, but to actually do stuff. I think my takeaway from the report that you authored, Vice Chairman Barr, was that it wasn't really a failure of the regulation itself. It was a failure of the regulators to actually take action on what they may have observed. And when I look at Silicon Valley Bank in particular, you know, what really triggered it was a run on the bank. And my question is, what triggered the run on the bank? So did you look into the wires out? Who was moving the money? How many individuals or entities were actually moving the money in the weeks leading up to the run?
Thank you for the question. You know, the fundamental issue at the bank before there was a run was that they mismanaged their interest rate and liquidity risk.
Yeah, I understand that. I'm curious about understanding I don't know any individual that managed their interest rate risk worse than Silicon Valley Bank. But my question is, what led to the run on the bank? Who was moving the money out?
So obviously for privacy reasons, we don't generally look at transaction accounts of individual customers. We can see the dollar flows. The dollar flows were enormous. Thursday afternoon, $42 billion in withdrawals. Lined up the next morning, another $100 billion in withdrawals. That was over 80% of the deposits.
Well, I think it's important when we look at the other part of our capital markets. This bank was shorted. This is a publicly traded bank. There were a lot of shorts in the bank. We're looking right now at a lot of pressure on our committee to try to say, oh, you guys have to ban short selling. Well, no, we don't. Well, there are some issues with, naked shorts and people actually having custody of the shares, more shares being lent than are actually available. There are some things that are still unaddressed post-GameStop on the shorting of publicly traded companies. But the problem here is, who led the short, and is that in any way correlated to the people that were moving the money out? And I think we've asked for that data, and we haven't gotten it, and we can look at it in the most confidential setting. I respect the fact that we shouldn't publish it online for everyone to see, but someone is looking into this, correct?
I don't actually have access to individual transaction level data. The SEC is responsible, obviously, for market integrity issues, and so that's a question really directed to them.
Okay, if the Fed doesn't, does the OCC have access to this data?
No, for the short selling data, no. I think that's...
No, not short sellers. I know you're not a securities regulator. You're a banking regulator. Who moved the money? Was it one person? Was it 2,000 people? How many different entities and individuals were behind what caused the cascade effect? It wasn't, it built momentum.
So SV was not an OCC-regulated bank, so I can't answer that question.
Okay. So if you look down at the state regulator would have these records, right?
I do not believe so, sir, no.
So you think this will be an unresolved mystery?
Well, as I said, the SEC has jurisdiction over market integrity issues. It's really a question.
We're not talking about market integrity. We're talking about bank run. which you guys are supposed to make sure doesn't happen. Does the FDIC have transaction data?
And I'd want to check on that, Congressman, and come back to you. We may have some ability to look. The issue is deposit withdrawals, and who is responsible for the largest deposit withdrawals and may have contributed to a particular bank failure. That's something we could.
If we look strategically, the risk of a major run on a bank is something that we should pay a lot of attention to. How would this be engineered? There could be a malicious intent behind a bank run. There could be a coordinated effort behind multiple entities to cause bank runs, and that would be a real problem. Would that be a problem if that was to happen, Vice Chairman Barr?
Depending on the facts and circumstances, it could be if there was.
Yeah, I think the answer is simple. Yes, it would be. I assume the rest of people, anyone object? Do you think it wouldn't be a problem? So, I just think when you look at market risk, the other thing, there's a lot of people pushing for more government. Seems like every kind of situation, the solution is more government. As most of you probably know, that almost half of privately insured credit unions are in my state of Ohio. Very big presence for credit unions in Ohio. And I guess, do you have plans to give them access to bank term funding program?
I'd see my time has expired, my answer.
Please.
You had time enough to answer that, so I mean, yes or no would be like respectful of the committee in like a bare minimum way.
The bank term funding program was set up immediately in response to the.
I understand the history. It's really yes or no.
We don't currently have plans.
Okay, gentleman's time's expired.
All right, thank you.
The obfuscation is clear. All right. So we just asked the panel to try to answer the question. I think members appreciate that and get less aggravated on a bipartisan basis. It also makes it go quicker for all of us. Thanks. With that, we'll now recognize the gentleman from Ohio, again, Ohio, Mrs. Beatty, for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses. Let me start by saying earlier, one of my colleagues wanted to point out you were appointed by President Biden. Mr. Gruenberg, if I ask you if the name Jelena McWilliams, is that a name familiar to you, and who is she?
She was the former chairman of the FDIC.
And she was appointed by?
President Trump, I believe.
Okay. And I could probably go down the list and do the same thing with you, with the National Credit Union Association. Does the name Rodney Hood mean anything to you, Mr. Barr?
Actually, I think.
I'm sorry, I looked down here. I'm sorry, Mr. Harper.
Yes, yes. He is currently a board member on the NCOA board and was previously chairman.
And he was appointed by?
President Trump at the time.
Thank you. Also, Dodd-Frank was mentioned earlier. Let me remind, as I recall, Dodd-Frank, if we go back more recently, it was President Trump who signed a law to roll back some of those critical parts of Dodd-Frank. And many believe had that rollback not happened, of rolling back the stricter oversight, since we're talking about oversight today, maybe SVB and Signature would not have had released those stronger rules and oversight, which would have made them subject to stronger liquidity and capital requirements, maybe just to withstand some of the financial shocks they took. And they would have been required to have regular stress tests to expose them to their weaknesses. That was just a statement and not a question for you all. Now, let me ask you, Mr. Gruenberg, I've been very interested in the deposit insurance reform in the wake of the recent bank failures. Back in March, you'll probably recall that right after the SVB collapse, I asked all the witnesses at that time the three reform options, which they thought were best. So now let me fast forwarding to last week. I asked that same question of all of our witnesses, and they all said targeted approach, whether they were a Democrat witness or a Republican witness. Would it make sense, do you believe, to focus on small businesses with that kind of approach?
Yes, and that's what we suggested in the report that we released, Congresswoman.
Okay, thank you. Mr. Harper, knowing that credit unions have a deposit insurance scheme, I would like you to weigh in on the discussion about deposit insurance reforms. What were your recent reactions to the FDIC report, and did any particular option resonate with you in particular?
So certainly, the first, if there are changes made in the deposit insurance fund, which the FDIC administers, we believe that there should be parallel changes made for parity in the share insurance fund that the credit union administration manages. Of the options presented, certainly the targeted option was the better option, and there can be some real policy reasons behind why you might want to do that. I'll also note that our small business accounts tend to be very small. We recently did a survey, and typically they're between $7,000 and $15,000 at our largest of credit unions where we've checked that data. But there are certainly some accounts where they are much higher.
Okay, thank you. Let me continue with you. Just last month, we opened a new MDI, a Black-owned MDI in Columbus, and the first in the great state of Ohio. And while I was proud of the achievement, the fact still remains that there are only 19 Black-owned MDIs in the United States. And that's a 43% decline just since 2001. And over the past 10 years, we've seen a number of the MDIs to decline by 20%. Is there anything you can tell me that you're doing to help preserve MDIs?
So first, I think when you said 19 MDIs, I believe
19
that's on
Black-owned.
Black-owned MDIs, but that's on the bank side. On the credit union side, we have in total 503 MDIs. I believe nearly 300 of them are actually Black-owned, so it's a sizable portion of our MDI marketplace. One of the things we did most recently was to change our examination procedures. We have to recognize that there's a different business model that MDIs have in working with the community, and sometimes that means that there are higher expenses. They shouldn't necessarily be penalized in their exam reports by being compared to non-MDI peer metrics. So we've done that. Also, thanks to Congress, we are now able to—
I think my time is up, but we can continue this later. And let me just say thank you to all the witnesses and also for making appointments to see me. Thank you.
Gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman McHenry, and thanks to Ranking Member Waters, and thank you to our august guest for being with us today. Acting Comptroller Sue, last year, Senator Elizabeth Warren sent you a letter urging you to block the TD Bank First Horizon deal. And reports suggest the deal fell apart 2 weeks ago because the two banks were not given a timetable for regulatory approvals. First Horizon stock is down 50% since the failed merger with TD Bank. As I'm sure you are aware, markets can handle good news, markets can handle bad news, but what markets can't handle is inconsistency. So, Acting Director Sue, what impact did Senator Warren's letter have on your decision to slow walk this merger?
Thank you for the question. So on every merger application, we follow the law, we follow our guidelines, we follow our policies and procedures. And by the law, we've got the Bank Merger Act. There are a list of statutory factors that a merger must, we have to consider the impacts on competition, on the convenience needs of the community, on financial stability, on the financial and managerial resources of the entity, on BSA/AML compliance. We have to take all those into account for statutory purposes. Under our guidelines, the Comptroller's Licensing Handbook, which is public, we list out the standards by which we apply, the framework we apply to evaluate those, and we do that in every single case.
So I'm wondering, you testified that the OCC is committed to being open-minded when considering merger proposals and to acting in a timely manner on applications. What about the OCC's actions during the TD Bank First Horizon merger was timely?
So every case is different. We do everything, we have to evaluate each case on its merits, and we do so applying those standards equally. But as I said, I can't speak to individual transactions. What I can say is different transactions have different features. Some of them can be dealt with more quickly than others.
So how long should banks expect for the OCC to typically approve a merger? Is it 6 months? Is it 12 months? Is it 24 months? U.S. Bank and Union Bank and Bank of Montreal and Bank of the West each waited over a year for their mergers to be approved, and TD Bank and First Horizon waited over a year without an answer. So I'm wondering, there's an old saying in the law, justice delayed is justice denied. Do you have enough staff at the OCC to review these things in a timely manner?
We do have enough staff. The closer that a merger hews to the statutory factors I just listed out, the faster that approval will go. I think this does highlight that the frameworks that we use to apply the statutory factors are old. They've been around since 1995. We have been working across the agencies, not just the OCC, but with the Fed, the FDIC, and with the DOJ to try to upgrade those, update those to current times. That's a project we're working on because we want to make sure that that's updated and modernized for today's environment.
I must say I'm skeptical about the timeline, and I wonder, how do you balance the need to promote competition in the banking industry with the need to allow banks to grow and innovate?
So again, we take each case on its own merits. We evaluate those against the statutory factors and against our guidelines. It's hard to generalize because each one of these cases is a little bit different.
Chairman Grunberg, as part of the deal to acquire First Republic, the FDIC have provided J.P. Morgan with a $50 billion note. I know you're familiar with that. What was the interest rate agreed to on that note?
I think it was 3% I'd have to double check on that, Congressman.
So is that the going market rate for a loan of that size?
I believe it was the market rate, but I cannot double check on that for you as well.
Do you believe that the financing at this rate satisfies the FDIC's obligation to resolve banks in a way that is least costly to the Deposit Insurance Fund?
In this case, yes, Congressman, we had a number of bids. The bids from J.P. Morgan was the least cost, and these were the terms we were able to negotiate.
Vice Chair Barr, in your view, would the interest rate risk that led to large mark-to-market losses on SVB's assets have occurred without high inflation in the United States that the United States has experienced since April of 2021 and the rapid rate increases engineered by the Federal Reserve to address runaway inflation?
The interest rate risk that it faced in the particular moment was related to the rapidly rising rates, yes.
Thank you.
Gentleman's time has expired. We'll now recognize the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Mr. Chairman. Mr. Barr, as we've been in this hearing, former CEO, Mr. Becker from SVB, has released his written statement for the upcoming hearing. In that statement, he indicates that in April of 2022, he led the effort to fire their chief risk officer, Laura Izarieta, in part based on feedback from regulators. I'm wondering if you can just confirm that regulators did raise specific concerns with Mr. Izarieta and had some impact on that termination.
My understanding is that supervisors concurred in the judgment of the CEO that the CRO was not up to the job.
Okay. SVB did not publicly disclose that they were without a risk officer until almost a year later on March 3. Were the supervisors aware that that information was not made publicly available?
I don't know the answer to that question. Generally speaking, bank supervisors are not in charge of providing advice to banks about disclosable or non-disclosable events. That's handled by the bank as part of its obligations under the securities law.
Okay, but presumably you would appreciate that risks to equity risk and risks to deposit risk all get intermingled in the mind of the CEO. During that period between when their risk officer was fired and they disclosed to the public that they didn't have a risk officer, they sold off $2 billion of interest rate hedges. Were you aware that they had sold that off? Were you in any way consulted, you or your office, consulted in the, essentially the de-insuranceification of their interest rate exposure?
I arrived at the Federal Reserve Board in July of 2022. I was not aware of any of the particular matters with respect to SVB until an information report in February of that year. February of this year. So,
well, if anybody else would care to comment, I want to understand they didn't have a risk officer. We knew they didn't have a risk officer. We knew they hadn't disclosed to the public they had a risk officer, and they were selling off interest rate hedges. Were the supervisors who had a role in getting the risk officer terminated aware of that change in their hedging strategy?
The supervisors became aware of the removal of those interest rate hedges. I don't know precisely at what moment they became aware of that, and they recognized that as a risk that the firm had incurred.
Okay. I really do appreciate your candor here, and in particular in the report that you sent before. I think it's appropriate to sort of acknowledge where we had some failures. We will be judged not by what we did in hindsight, but what we do going forward. As of right now, the spread between the ask yield on treasuries with a due date of May 31st and June 15th is 100 basis points. And of course, the credit default swaps on U.S. treasuries are priced about 8 times as high as they were a few months ago. Given what we have just learned about banks, SVB particular, not maintaining a robust hedging strategy, are you monitoring the changes in interest rate hedging among the banks you supervise?
We are intensively supervising all banks for interest rate risk and liquidity risk. We look at all the ways that they measure interest rate risk and all the steps that they take to mitigate that risk. That could include, for example, hedging.
Are you compelling them to be more aggressive in light of the potential default on U.S. treasuries that's coming up in a few weeks?
We're calling attention really to the broad range of interest rate risk. There is a heightened risk with respect to the debt ceiling that is part of that interest rate risk.
Are you going beyond the SIFIs, or do you not have the jurisdiction to go to supervise
The interest
beyond that
rate
level?
reviews that we do are for all of our banks. There's more intensive supervision and regulation of the GSIBs, the largest firms. There is less intensive but still quite active supervision on interest rate risk with respect to other firms.
Okay. If we blow up, and I would remind my colleagues that we expanded the debt limit every time when Trump was president, and every time in the last decade when Republicans have controlled the House and there's been a Democratic president, they've played suicide with the economy, and the last time we did downgrade our debt. If we do that again, as we seem to be on a trajectory to do, and U.S. treasuries are no longer a zero-risk security, how much capital will the banks have to raise instantly in order to be compliant with Dodd-Frank?
The obligation obviously is on Congress and the executive to work out an arrangement on the debt ceiling to raise it.
I understand that, and I hope we do, but the adults are not in charge. If we don't, are we going to force the banks to raise that capital? And I don't like the politics of this any more than I think any of us do. But my fear is that if we find ourselves with our prudential regulators in a choice of saying, do we provide stability to the banking sector and blow up the economy or vice versa, none of us are going to like
The
those
gentleman's
politics.
time's expired. The chair now recognizes the congressman from South Carolina, Mr. Norman, for 5 minutes.
I think all during the I think y'all have been here 2 times. You've gotten a sense of that there has not been a sense of urgency as it comes to the regulators, or as you put it, your supervisors. With SCB, you had a bank that went from $71 billion to $200 billion in 36 months. You had a case where 94% of their deposits were above the limits, where they had insured. You had a risk-based officer that was not there. Who supervises the supervisors? Mr. Barr, and then I'll ask Mr. Greenberg.
It's ultimately my responsibility to make sure we have effective supervision. We did not in this case, and we're going to fix it.
Was anybody fired?
Not at this time, no, sir.
Not at this time. You got 22,000 employees. Nobody was fired. You got a bank that's the taxpayers are going to suffer the consequences. Mr. Greenberg, you've got, if my math's right, close to 2,800 examiners. Anybody fired on this case?
No.
Nobody was fired.
Nobody has been fired. As I indicated, we've had the GAO report, we've had an
I get all
internal
that.
And
So,
we are going to do, and we're in the process of doing a comprehensive review of our supervision program,
Okay.
including our staffing structure.
Could you walk me through, Mr. Greenberg, your FDI's decision to backstop all of SVB and Signature Bank's uninsured deposits? I get the systemic designation, but why was that decision made so quickly? And if you could do it quickly, because I got a question I want to ask Mr. Harper and Mr. Hughes.
I think this evolved over the weekend when Silicon Valley Bank failed, as you'll recall, on Friday morning. it became apparent to the FDIC as well as the state supervisor in New York that a Signature Bank would probably be unable to open on Monday. So we really had a circumstance, and the failure of Signature appeared to have been prompted by a contagion effect from the failure of SVB. And we also had information that other institutions were coming under significant stress.
I can tell you there's a good bit of stress that's going on right now. Is both of your opinion, is the banking system in good shape right now?
I think we would both characterize it, I think, as resilient and stable.
So it is in good shape?
I think it's...
Okay, so you don't have any concerns?
Oh, no, I made clear in my written statement and in my oral statement, there are significant downside risks that we are paying close attention to.
Mr. Barr, is the banks in good shape now?
So I would repeat also that overall the banking system is sound and resilient. There are stresses in the system that we're carefully monitoring.
Will they be acted upon with the supervisors put a sense of urgency when you see the headwinds that these banks, SVB and others have had? Would you act a lot quicker now with the same, since no one's been fired, you got the same people in charge?
We would act with greater speed and agility and force.
Okay, to try to head this off, which that would be a good thing. Okay. Mr. Harper, the National Credit Union Association released a request of information on climate-related financial risks, which posed 38 questions about fiscal risk, transition risk, governance, and other topics. Is this appropriate for an agency to do this when it hadn't been approved by Congress?
So our interest in this matter is we are looking at all material risks to credit unions. We're gathering information related to climate.
But what I'm asking is, the 38 questions that you put,
yes,
are you comfortable that none of what you're requesting has gone through the congressional review process?
So it's been the congressional review process would not apply to a request for information, as I understand it.
Why?
We've not adopted a rule, and it would apply.
But you're still making them give them information, take their time, and I don't know how many employees you've got.
We've got about 1,200.
1,200, yeah, 1,275. Okay, and so I guess you're comfortable without any direction from Congress requesting this information, have the time, and putting your staff through answering these type of questions with climate risk.
So we passed this particular request for information on a 2-to-1 vote. The 2 was actually a bipartisan vote, if that is your concern. In addition to that, though, we're looking to gather information so that we can better understand what are the risks.
You know what the cost of this is to your bank?
Do you want what?
Do you know what the cost of complying and answering all these questions is to your bank?
So a credit union can choose to not answer it
okay,
or
so
to answer it.
It's voluntarily.
Yeah.
Okay, I yield back.
Thank you. The gentleman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you so much to our witnesses for joining us. Since Vice Chair Barr and FDIC Chair Gruenberg last testified in front of this committee, as we all know, another bank has collapsed, so that's 3 bank failures this year. And the Federal Reserve's report on the collapse of SVB underscores that bank executives committed quote, unquote, textbook failures in managing interest rate risk, and regulators failed to understand the depth of the problem and to react appropriately. Certainly, the 2008 financial crisis gave us all a front row seat. The entire nation learned in that moment that we cannot solely rely on the decision-making of executives to ensure systemic stability. So this is not a new issue. This is no epiphany here. Chair Gruenberg, as you well know, and I want the public to know, that banks are subsidized by the government through the Deposit Insurance Fund and their access to the Fed's liquidity backup facilities. Banks perform what is essentially a delegated public responsibility, including providing transactional accounts, operating payment systems, and serving as channels of monetary policy. So, Chair Gruenberg, bearing this in mind, would it be fair to say that banks operate similarly to a public-private partnership?
It's an interesting, they certainly have a public charter and a set of public responsibilities that comes with their charter and the provision of public support. And that is also why they incur the obligations relating to both supervision for safety and soundness, as well as consumer protection and community reinvestment.
Very good, thank you. I think it's an accurate characterization. However, it is a skewed public-private partnership because the profits are enjoyed by the private bank, but the losses are borne by the public. So for too long, banks have been content really to chase profits irresponsibly and then to turn to the government to bear the risk when they collapse. If the American public is going to suffer the consequences of poor corporate governance, then maybe it's time for the American public to have a seat at the table. One proposal that would do exactly that is to give the government a special government share, or what some would call a golden share. The way it will work is simple. The federal government would receive a unique share in large banks that are considered systemically important, which would allow for a government-appointed director to join the bank's board and be responsible for representing the public interest. Now, under normal circumstances, the director would keep an eye on proceedings and not interfere with the day-to-day affairs. But when credible concerns arise that the bank is mismanaging its risk and threatening our economy, then the director can act as an early warning, early action system to prevent a potential crisis. So Vice Chair Barr, it's my opinion having a government-appointed director at SVB could have helped to avoid the now obvious mistakes and errors and repeat of history here. Do you agree that a board member with a unique public mandate would support around remedial measures, early intervention, and then the director would have been more ideally positioned to spot and flag the problems with unhedged interest rate risk and over-reliance on wholesale deposits that the executives were willing to ignore?
The system we have for that now is that the board of directors has that responsibility. They are required to oversee the management of the firm in a way that takes into account appropriate risk management. And the board, in this case, failed to do that. The senior officers of the bank also failed to appropriately manage their risks. And as we outlined in our report, the supervisors called out those risks, cited them for the risks,
I'm sorry.
but did not.
The time is elapsing. I'm so sorry. So actually, I don't apologize. I'm just going to reclaim my time. And you said fail there several times, and I think that's the point, is that we don't want this to happen again. The swift government intervention to ensure all deposits and prevent a systemic crisis showed us once again that the profitable business of banking is deeply intertwined with public interest. So the golden share proposal would allow an appointee on the board of large banks to safeguard the public interest. The reoccurring bank failures demonstrate that bank executives are not making decisions in the best interest of the people. The American people deserve a seat at the table. Thank you.
The gentleman's time has expired. I now recognize myself for 5 minutes. Mr. Barr, I know we've talked about this a lot today, but do you believe that banks in the United States are well capitalized?
They've said that repeatedly, that banks, according to our rules, are well capitalized today. Our banking system is sound and resilient.
So if you do believe that banks in the U.S. are well capitalized, what is the point of your capital review?
The capital review is to look at whether the capital rules are appropriately meeting their objectives, whether, despite the fact that the capital in the system is strong, it might be the case that it needs to be stronger, and that the banking system might need additional capital to be more resilient, precisely because we don't know the nature of the kinds of ways we might experience shocks to the system, as has happened with these recent bank failures.
So it's your contention that the current regulatory framework is somehow inadequate, but you just said that you believe that banks are well capitalized. I mean, SVB did not fail because of inadequate regulatory capital. SVB failed because of a massive deposit run fueled by a social media blitz from some of SVB's own depositors. concentrate uninsured deposits in large volumes of assets bearing interest rate risk that the Fed missed. So you, as the Vice Chair of Supervision, missed all of that until it was too late. How can anyone expect any framework of regulation to work if the regulators don't implement and enforce it?
We do need to focus on both. We need to focus on strengthening our system of supervision so that it's more agile, it's speedier, it's more forceful. And we also need to make sure that we have the right resiliency in place in the system. A firm like SVB, ultimately the depositors ran because they felt that the firm was not solvent. So capital and liquidity issues are really intimately intertwined.
Well,
and that's why we're looking at capital standards.
They were right, it wasn't solvent, but it was your job to make sure that they maintain solvency, and I don't understand how we're going to reassess capital requirements if the previous ones weren't faithfully implemented, and I don't see how this is productive.
The previous capital requirements were in fact faithfully implemented. The question is whether they were robust enough. So for example, in SVB's case, had they been required to record their unrealized losses and gains on available for sale securities, that would have had a $2 billion impact.
So we're going full circle now. I mean, the first question I asked you was, are banks in the U.S. well capitalized? It seems like the answer to that is possibly no, or, I mean, you can't have it both ways. You can't say that banks are well capitalized and also say that we need to reassess capital requirements.
The rules that we use the term well capitalized to describe a bank that exceeds our capital requirements as they currently exist. It doesn't make a comment with respect to whether those are the appropriate rules, and that's what we're exploring as part of this review and part of the joint work that the three agencies are undertaking with respect to the Basel III endgame, is do we have capital requirements that appropriately measure risk, and are those measurements robust enough to the kinds of shocks that we might experience in the future?
The size of the runs on the banks that have failed would not be sustainable by any bank of their size. So I don't see any capital requirement that could be imposed for certain banks that would address the concern. We're just going to move on. Recent bank failures were prompted by poor interest rate risk management and asset liability management. To put it simply, failing at basic banking 101, these banks did not appropriately recognize or manage the interest rate risk associated with a high proportion of unstable deposits and longer duration assets. This was widely recognized in recent postmortem reports across your agencies. Chair Grunberg, why did the FDIC decide to base this recent special assessment solely off of uninsured deposits rather than use a risk-based assessment unique to each bank like traditional deposit insurance?
First of all, as you know, we're required under law to impose a special assessment to recover the cost of the deposit insurance fund of the systemic risk exception. The systemic risk exception covered uninsured deposits. That's what it was used to do. And we have authority under the law to impose a special assessment on the institutions that benefited from the systemic risk exception. As our staff reviewed it, we thought the most appropriate way to try to link the benefit of the systemic risk exception to the institutions that benefited was to track it with the amount of uninsured deposits.
Thank you. I yield back, and the gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Mr. Chair. The latest bank failures have held up a mirror to the two-tiered banking system in the United States. If your bank is too big to fail, it has an implicit guarantee of unlimited deposit insurance. But if your bank is too small to have an implicit guarantee of unlimited insurance, then in some sense it becomes too small to succeed. Too big to fail versus too small to succeed. Vice Chair Barr, how do you solve the problem of a two-tiered banking system in the absence of unlimited deposit insurance?
Well, let me start by saying that overall our banking system is sound and resilient. Our community banks are serving their community. They're vibrant. They have been engaging and will engage in efforts to make sure that they are safe. All depositors should feel that they are safe. If you look at the actions that banks have taken recently to make that the case, and regulators have as well. So I don't think that we have a structure where depositors should feel differently about their deposits depending on the size.
But it's fair to say there have been outsized deposit flows to the biggest banks based on a perception of a two-tiered banking system?
We did have a period of time in the acute stress moment in March where there were significant deposit outflows from some regional institutions to larger institutions. With announcements that the agencies made and the establishment of the Bank Term Funding Program, deposit outflows for almost all institutions normalized to what they had been prior to that stressful incident.
So I want to speak about a new source of stress. New York City has the largest commercial real estate market in the United States. Commercial real estate, particularly office, is confronting the worst of both worlds, declining property values and rising borrowing costs. The combination of work from home and rapidly rising interest rates has been a calamity for office real estates, particularly Class B and C. $270 billion in CRE mortgages are reaching maturity in 2023. A third of those mortgages are office. Vice Chair Barr or Chair Gruenberg, how high is the risk of commercial real estate causing a new wave of bank failures?
We are looking carefully at commercial real estate risks. As you point out, there are some downtown office commercial real estate deals that are especially vulnerable. We are in a somewhat better position than in prior downturns in the sense that the loan-to-value ratios prior to the reset in pricing were muted. And so the price resets that we're likely to see, there's more capital than there had been in prior crises to absorb that. There's also a lot of heterogeneity around the United States in terms of how exposed different banks are to those risks.
Do you think any loan restructuring can or should be undertaken to prevent a cascade of defaults in CRE market?
I do think that banks already are in the process of working out commercial real estate loans where they see those risks in appropriate places.
For the comptroller, before the creation of the OCC, there was no uniform national currency, only a cacophony of currencies. Each local bank could issue its own banknote, creating more confusion than clarity and ultimately ending in failure, hence the OCC. In January of 2022, you gave a speech analogizing stablecoins to pre-Civil War banknotes. Left unmentioned in your speech, however, is the obvious difference between the two, the fact that stablecoins, particularly dollar stablecoins, are pegged to a uniform national currency like the dollar. Is it fair to say that a stablecoin system based on a uniform national currency like the dollar is qualitatively different from pre-Civil War banking system that had no basis in a uniform national currency at all?
Thank you for the question. So I think the uniformity has multiple dimensions to it. So one is what it's pegged to, the one that you highlighted. I think that's one form of uniformity that's important.
Which was absent from the pre-Civil War banking system.
Well, I think that historians may debate that. I think the one in the free banking era, pre-Civil War, the issue where there was not uniformity was in the chartering and the supervision of the different banks. And I think that that is the case with stablecoins. The chartering, the supervision, and the standards to which stablecoins hold themselves are not consistent. And I think that that's something to be wary of.
With respect to dollar stablecoins, or?
I think all stablecoins.
So if you had a fully reserved stablecoin that's pegged to the dollar, in your mind is equivalent to a banknote that had no national banking system and no national uniform currency?
Well, I think it's important that that's one important element of having a stablecoin.
The gentleman's time is
prudent. But I think there's other elements which we want to pay attention to.
The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you, Mr. Chair. The NCUA recently released a request of information on climate-related financial risk, posing 38 questions about physical risk, transition risk, governance, and other topics. Vice Chairman Harper, regardless of the responses that you get back on this, I'm just wondering where this came from, and do you think it's appropriate for the agency to regulate in this area? There doesn't seem to be any clear directive from Congress along those lines.
So three things here. First, we have seen credit unions that have gone under. For example, we lost 2 credit unions after Hurricane Katrina went through that are related to climate-related financial risk. Second, All of the regulators have been issuing RFIs in this area to gather information. If this were a definitive step forward in being towards regulation, we could have released it as an advance notice of proposed rulemaking. We didn't. We're gathering information so that we can help credit unions better understand what are the material risks onto their balance sheets related to climate. We know that certain institutions who are located in areas where there are greater risks have certain risks, and they need to think about how do they mitigate those risks and offlay those risks. Also, too, one of the things that the agency has done exceptionally well over the years is to develop tools for small credit unions to use. For example, our simplified CECL spreadsheet, as well as our automated cybersecurity evaluation tool. Both of those have helped credit unions to comply and to bring in and make sure that they're doing the right things in this area. We may well develop a tool, not necessarily a regulation in this area, but it's worthy of exploration.
I think the concern is, and I think many members of Congress hear this on a regular basis, whether you've got a group of credit unions in your office here in DC or you're back in the district, is just any time one of these requirements is put in place, you know, for them, it's something then they have to react to, oftentimes maybe even hire a full-time person to react to this. And I'm wondering, do you ever do kind of a look back on that to see just what type of impact you're having on credit unions?
So certainly, I mean, one of the things that's been an agency principle for many years is looking at the size, scale, and scope of our regulations. We know that 3 out of 5 credit unions are less than $100 million in assets. They need to be focusing on their local communities and lending in their communities and making sure that the loans are getting paid on time and supporting the community. Therefore, for credit unions under $100 million, we've scaled our regulations that they have fewer things to comply with. It's only as you grow in size and scope that you become subjected to more regulations. For example, on our liquidity rules, credit unions above $250 million in assets are required to have access to a federal backstop, either being our central liquidity facility or the Federal Reserve's discount window. We adjust accordingly because we do recognize the burden on communities.
Very good, thank you. Vice Chair Barr, after the questions asked by the Federal Reserve and the FDIC in the joint proposed rulemaking on the large bank resolution, we've heard some concerns that institutions could be assigned a bank category that does not necessarily match up with kind of the risk-based indicators that are out there. I'm wondering if you have any comment on that, or if are you aware of this?
I'm not sure I fully understand the concern, but we are taking into account in thinking about the proposal with respect to long-term debt requirement, the risk profile of institutions, and so that does go into our thinking. I think what we saw—
And then capital standards that would be required, right? I mean, all that would, yeah.
Correct. We think about the risk basis for capital requirements as part of the work that we're doing together as agencies.
Okay. Yeah, just another, so how many matters requiring attention did SVB receive from the San Francisco Fed? Do you know what that was?
Well,
I mean, there were a number of them, but
At the time that the bank failed, it had outstanding 31 matters requiring attention or immediate attention, which is about triple the average for that peer group, so quite a lot.
But of those 31, none of them really played a role in the downfall of the bank ultimately, right?
The issues that were raised in a number of those related to governance, basic governance, risk and controls, interest rate risk, and liquidity risk. So
the gentleman's time has expired.
The MR.
Yeah. Very good.
The gentleman from Colorado, Ms. Peterson,
back.
is now recognized for 5 minutes.
Thank you, Mr. Chairman. This hearing is timely and necessary now that we have more detailed information about what led up to the failures of Silicon Valley Bank and Signature Bank, the third and fourth largest bank failures in our nation's history. Between Friday, March 10th and Sunday the 12th, the FDIC, OCC, and the Fed acted as swiftly as they could to take stock of the assets, seek buyers, and then, when no suitable purchaser could be found that quickly, insured all depositors. Once again, I want to thank you for your timely action and for protecting small businesses and individuals throughout our country and in my district. But a common theme today is that regulators were clearly able to identify problems with the risk management practices at Silicon Valley Bank and Signature Bank several years before leading up to their collapse. However, attempts at corrective action were slow and inconsistent. Vice Chair Barr, you've said that you have the tools that you need to act differently in the future, and you have also said that we need a culture that empowers supervisors. Were the delays and inconsistencies with the regulatory flags in part because of worrying about the backlash you might face from the industry and even some of my colleagues here in Congress if you actually utilize those tools? What did you mean by stating that we need a culture that empowers supervisors?
We need to set up a system such that supervisors, when they're faced with uncertainty, act. And when they see a bank not responding promptly enough, they feel empowered to escalate those matters with putting in place, for example, limitations on capital distributions, incentive compensation, putting in place higher capital or liquidity requirements, escalating matters to the enforcement at a prompter speed. And so I think that is a really important part of the kinds of reforms that we need to undertake.
Thank you very much. That leads me to my next question. The FDIC issued warnings to SVB in 2019, 2020, and then on four separate occasions in 2021, and then in 2022, SVB was prohibited from acquiring any other banks. In hindsight, we know that that prohibition was insufficient. Then in 2023, just 2 weeks before the bank failed, the CEO sold $3.5 million in stock. The employees of SVB received their annual bonuses on Friday, March 10th, just hours before the bank failure. We will hear more from the executives tomorrow about this, and it's concerning for me. But if regulators identify problems with risk management policies and capital and liquidity issues, do you think their executives should be able to sell stock and receive bonuses before the regulatory flags are addressed? Would anyone like to take that?
I'd be happy to address it. I share your concern. I thought the fact that bonuses were paid the day the bank failed was outrageous. We are investigating that. We'll take full action depending on the findings of that investigation. With respect to the stock sales, that is, generally speaking, an issue for the SEC, and I defer to them on it.
Congressman, I would add that in addition to the authorities that the Fed has in regard to SVB, as part of our resolution of SVB, the FDIC has a legal obligation to investigate the board and management of the institution for any misconduct that may have occurred. And we have considerable authorities, including ordering restitution and also banning individuals from the business of banking if our investigation finds appropriate misconduct. And that's something, those investigations are underway now.
Thank you for that information. Quickly, Mr. Hsu, you've said that our deposit insurance should be updated, and you've also recognized the balance between higher coverage and higher costs. What considerations should we be making when we look at balancing the increased cost with protecting depositors and the risks that bank runs pose to our entire economy? Should we be treating individual depositors differently than small businesses, and what could a tiered approach look like? 30 seconds.
Well, thank you for the question. The FDIC report on deposit insurance lays out the trade-offs really well. And so I encourage folks to look at that. There are some hard balances to be made between financial stability and some of the moral hazard issues that are out there. So I think the report does a really good job of laying that out, and we look forward to working with you and others on working through that.
Great. Thank you all so much for being here. I yield back.
The gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Harper, in addition to serving on this committee, I am also the chairman of the Cybersecurity Infrastructure Protection Subcommittee on Homeland. One thing that I've continually heard from industry is that there's a need to harmonize cyber regulations across the federal government. As I'm sure you're aware, the National Credit Union Administration Board approved its final rule on cyber incident reporting this past requirements this past February. It's my understanding that while not fully implemented, this rule directly conflicts with congressionally mandated cyber incident reporting for Critical Infrastructure Act that we passed and was signed into law last year. Did the NCUA work with Director Easterly at CISA or any other federal entity on the development of this proposal? And did you analyze how your 72-hour rule interacts with existing regulations and laws?
So certainly, we fully did consider the CISA rules, and in fact, we aligned ours with the 72-hour limit to be with theirs. What we see is this, it should be a hand-in-glove work. We don't want any conflict between the two, and if there is conflict, we'll work to resolve it. But it's my understanding, according to staff, that we have resolved that already, and there is no conflict.
All right. Well, we had someone from the ABA came in front of my committee and said that 40 to 50% of their employees, their cyber employees, are spent dealing with regulations. So if there is conflict, which I believe there is some, I think it would be great if you worked with CISA to make sure that whatever reporting they have to do back is not duplicative, and that these cyber employees need to focus on defense instead of.
No, I fully agree.
And also, it is my understanding that the NCUA will provide additional guidance prior to the final rule going into effect, but it's yet to be provided. Do you have a date on when that will be available?
So the rule itself goes into effect in September. We're working to set up the reporting systems, and once we have those details ironed out, we will provide that additional guidance. In fact, we will be having a card with reportable, not reportable, to help to make it much easier to understand what incidents would arise.
I appreciate that. Thank you. Mr. Grunberg, I have a question about the FDIC special assessment. Unlike traditional deposit insurance, which leverages a risk-based assessment unique to each bank, the FDIC's proposed special assessment rulemaking leverages uninsured deposits as a mechanism to assess banks. To what extent is there variation in the overall stability of uninsured deposits, and to what extent would this framework differentiate across uninsured deposits that may have different characteristics?
I think the proposed special assessment is really based on the amount of uninsured deposits that a particular institution has, because the extraordinary action that was taken under the Systemic Risk Authority was really focused on protecting uninsured deposits. So the assessment would be across the board based on the amount of uninsured deposits an institution has, but there's an exception built in, so all institutions with less than $5 billion of uninsured deposits would be exempted. That way, community banks are exempted from the application, and the burden really falls principally on institutions with assets over $50 billion.
So instead of basing this special assessment off of the, so are you saying that the special assessment is purely based off of the amount of uninsured deposits, and it doesn't matter? That was the only reasoning,
Yes.
is because of what just?
That's what was protected under the systemic risk exception. The statute gives us authority to target the special assessment on the institutions that benefited from the systemic risk action, and that was really the basis.
So because uninsured deposits were protected, we're basing the assessment, that's the only reason we're basing the assessment off
That's
of
right, and
uninsured deposits moving forward.
That's correct, Congressman.
Okay, thank you. Mr. Barr, just quickly, separating recent bank failures from changes to capital requirements, recent reports show that Basel III revisions proposal could result in a 20% increase in capital levels for the largest banks, marking arguably the most comprehensive overhaul of the regulatory framework that the industry would only have a few years to comply with. According to academic literature by Basel Committee of Banking Supervision, a 1% point increase in capital requirement could potentially reduce annual GDP by up to 16 basis points. What impact on lending and the real economy do you think such swift and strident requirements will have, and how are you controlling this?
Any rule changes we make would go through notice and comment rulemaking process and have appropriate transition. So we're not talking about something that's immediately
The
effective.
gentleman's time's expired. The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Since the rapid bank failures we witnessed in March, there has been a wave of uncertainty rippling through the banking system. Regulators took action following those failures to help protect depositors and ensure their funds were safe at other well-managed banks. that do not suffer from the same issues that plague Silicon Valley and Signature banks. Following the collapse of those two banks, however, I have heard reports from small, medium, and regional banks coming under pressure from short sellers hoping to benefit from the turmoil in the banking sector by driving down the value of banks in the same asset class as those who've failed. Vice Chair Barr, if I can start with you. I sent a letter to the SEC today encouraging the Commission to monitor for illegal and abusive short-selling practices and to use appropriate authorities to prevent misconduct in financial markets. In the SVB report, you wrote that despite recent events, our banking system is sound and resilient with strong capital and liquidity. Are there wider systemic issues at play threatening the competitiveness of small and regional banks, or is it your sense that these short sellers are trying to make a quick buck by taking advantage of uncertainty in the banking sector? Thanks.
I do think the banking system is sound and resilient. There are a number of banks that have come under recent stress. Some of that has to do with a rapid decline in their stock price, which is a function of short interest and also decline in long interest. And those factors together have reduced the market value of those firms, and that puts additional pressure and stresses on the banking system.
Do you think social media is also at play there?
I do think the role of social media has been intensified. Certainly with respect to Silicon Valley Bank, the speed with which the bank failed was something that had not been seen before. And that's a function of, in part, of social media and part of the highly network concentrated depositor base of that institution.
Do you think thank you, and do you think the SEC should do everything in its power to identify sort of misconduct in financial markets like those and block that kind of activity or abusive trading strategies? I mean, there's, of course, short and long markets, but what if we're seeing abusive practices?
As you mentioned, that's a matter for the SEC.
Thank you. In reading your report on SVB, I found it alarming that the Fed was aware of many factors that ultimately led to the bank's collapses that obviously others have pointed out today, but failed, in my opinion, to move quickly and forcefully enough to prevent its failure. In the report, you outline recommended changes for the Fed board to consider related to its supervision and regulation of the banks. As you consider changes to the Fed's oversight of the banking system, how will you ensure that small, medium, and regional banks remain competitive?
We are looking very carefully at the impact that any change would have on our banking system. As I mentioned at the outset, I think having a diversity of institutions is absolutely critical for our country. We're well served by having a wide range of community-based institutions, regional banks of different sizes, as well as our largest institutions. And so the kinds of approaches that we're taking in the main will be focused on larger institutions over $100 billion in size. We haven't seen these difficulties with respect to our smaller institutions. And so the approach we're taking will be one that's really focused on that risk.
Right, and we need those smaller institutions, right? Key to our...
Absolutely. As many of you know, in your own communities, community banks play a vital role in their local communities with small business lending, support for community activities, engagement in the community. They really know their market and serve it well.
Thank you so much. Small and medium-sized banks, I agree, play a crucial role in our communities, and so I'm grateful for your comments. Chairman Gruenberg, earlier this month, the FDIC released a set of recommendations for reforming deposit insurance. You listed three main options for reform: limited, unlimited, and targeted coverage of deposits. Can you briefly explain these options for reform and potential implications for the competitiveness of small and medium-sized banks in particular?
Thank you, Congressman. We did lay out three broad options. One, essentially keeping the system the same as today with possible upward adjustment of the coverage across the board, but not full coverage. Second option would be full coverage. Third option is what we called targeted coverage, particularly focused on business payment accounts. Of the three, we thought the one that best balanced the objectives of enhancing financial stability while mitigating moral hazard was the third option, the targeted approach on business payment accounts.
How do you think that would affect, if you could just in the last 20 seconds here, the implications for competitiveness of small and medium-sized banks, regional banks in particular?
I think that would, I mean, to the extent that, they particularly serve small business, and small businesses rely on those business payment accounts, higher coverage would actually be of benefit to smaller institutions in that regard.
Thank you. I yield back. Thank you.
Gentlelady from California, Mrs. Kim, is now recognized for 5 minutes.
Thank you. I couldn't find the button. Thank you for being here. The recent bank failures have been anything but transitory. Since SVB's failure, I have reached out to many of my contacts, regional banks, community banks, and countless executives from small and medium-sized financial institutions in my region to first gather input and to check in on them and get their thoughts on those bank turmoil and the proposals being debated. Smaller financial institutions agree that they don't want the federal government to use the recent crisis as an excuse to increase regulations and reduce liquidity in the market through stronger capital requirements. So I want to ask you a question to Vice Chair Barr. I know you assumed the office since July of 2022. So from the time you took office to the time SVC's failure, you have been sworn in for nearly 8 months at the time. So could you please tell the committee what were your top priorities during those first 8 months in office?
The bulk of my time was spent looking at a holistic review of capital, which we conducted and are in the process of completing, working with the very largest firms, the GSIBs, looking at putting in place a long-term debt requirement for firms to enhance their resiliency, looking at the ways in which we could improve the way that we look at bread and butter issues like
bread and butter
interest
issues.
rate risk,
Mr.
and
Barr,
liquidity
thank you so
risk.
much. But I know a lot has been said about the interest rates too, right? With interest rates increasing as a result of high inflation, did you and your office ever make the interest rate risk or bank mismanagement a priority during that first?
Yes, as I mentioned,
office?
interest rate risk and liquidity risk are bread and butter issues of supervision. The staff has increased attention on that as a result of increases in interest rates. We issued a report in the fall of last year that highlighted interest rate risk as a core risk. So there has been an ongoing process to make sure that interest rate risk is appropriately addressed by supervisors.
So it is alarming that the Fed knew of the alarming interest rate risk through the, forward guidance. Yet, according to some reports, not since 2015, has a stress test involved rising interest rates. Instead, the Fed interest rate scenarios assumed a fall to near zero in every case. So to me, it seems that the Fed is focused on addressing the risks of the past when we must be focusing on the risk of the present. So last month, NFIB also said that small businesses are facing more difficulty getting a loan last month than at any time in the past decade. So the question is, we already have a very fragile economy where small businesses need reliable and affordable access to credit. So I'm going to ask you a couple questions all at once. How are you assessing the trade-offs between higher capital and strong economic activity and credit? And have you engaged with small business stakeholders to fully understand the impact the conclusions of your review will have on them?
Thank you very much. Just first, with respect to stress testing, I agree there should be multiple scenarios for stress testing, including testing rising rate environments. We're doing a pilot test of that this year with respect to a market shock, and we intend to issue a proposal about multiple shocks going forward. So I agree with you about that. With respect to capital requirements, we're looking at proposals that will go through notice and comment rulemaking and then have a transition period for them. So we're thinking about capital requirements that apply well out into the future. We're not thinking about or focused on today because the capital requirements would apply.
Do you have
after an
timeline for
appropriate
those
transition
holistic
period.
review, and when do you plan to release it? Timeline?
I expect that this summer that holistic review will be complete and the interagency process with respect to the Basel III endgame will also be complete, and we'll be able to speak about those issues in detail, and then the public can comment on those and we can take feedback.
Okay. you know, Mr. Su, in bulletin issued in April 26, the OCC stated that it
Ladies'
has...
time's expired.
Chairman, thank you so much. I'm out of time. I yield back.
Gentlelady's time has expired. The gentleman from Nevada, Mr. Horsford, is recognized for 5 minutes.
Thank you to the chairman and ranking member for the hearing today and to our panelists for testifying. I want to begin by discussing community development finance institutions and minority depository institutions and what we're doing to expand and to protect them. According to the latest list of federally certified CDFIs from April 14, 2023, Nevada has only 2 CDFIs, Greater Nevada Credit Union and the Rural Nevada Development Corporation. Additionally, based on data available, MDIs, there are 0 chartered in the state of Nevada. This is completely unacceptable. It's something I've been working with the Deputy Secretary of the Treasury on, and I hope that I can enlist your support today, particularly because Nevada is one of the most diverse and growingly diverse states, with the vital mission of supporting capital investments to historically excluded communities. These institutions are immense drivers of economic mobility. I know that the CDFI Fund has taken steps to overhaul its certification process after concerns were raised that certain firms were not truly focused on uplifting the communities that they are meant to serve. I think these need to be decertified, in fact. Vice Chair Barr, CDFIs and MDIs, which serve the small businesses and communities, are feeling the pinch of tighter credit standards, are also feeling a pinch of their own, with investors and larger banks pulling back on lending. Does this trend signal to you that we need stronger incentives, such as the Community Reinvestment Act, so that banks are encouraged to make investments in those community financial institutions that I mentioned?
Yes, I think you raise an important issue, and I have been working on ways to support the community development financial institution field and the MDI field for more than 25 years. I think that they do absolutely critical, important work in serving their communities. The joint interagency proposal on the Community Reinvestment Act does increase the incentives on banks to serve local communities, including through support for CDFIs and MDIs, and I look forward to working with my colleagues here to finalize that rule.
Thank you. Chair Grunberg, banking agencies are required under the law to preserve and promote minority depository institutions. Are there reforms that the FDIC and Congress can consider to ensure resolution planning and resolution procedures provide better opportunities for MDIs to participate in the acquisition of a failing bank, perhaps through a joint bid or being able to take part of the business being sold?
Well, thank you, Congressman. That's an important issue that we've devoted considerable attention to. When we've had instances in which an MDI has come under stress and has a risk of failure, our resolution division works with other MDIs to see if we could facilitate an acquisition of the troubled institution by another MDI to assure it continues its status and mission as a minority depository institution. In regard to when a larger institution may enter resolution, there's opportunities for MDIs to partner with other larger banks that may be interested in making the acquisition in order to participate, and that's something we also make part of our resolution process.
Thank you. Acting Controller Sue, I read your written statement and agree with your assessment on the importance of revitalizing MDIs. MDIs are on the front lines of serving low-income, minority, rural, and other underserved communities and are a critical source of credit for them. You stated the number of MDIs has decreased, and they have historically faced challenges with accessing capital, adopting new technology, and modernizing their infrastructures. In July of 2022, the OCC issued an updated policy statement on MDIs that reaffirms the agency's commitment to these institutions and describes the range of the programs in place to support MDIs. I'm also aware of the Project Reach program that you've initiated. Can you elaborate on any other efforts the OCC has underway to support MDIs?
Sure, if I can just say a quick word on Project Reach. As part of that program, one of the 4 major work streams is revitalizing MDIs. And one of the main tools we've used is a pledge from larger banks to commit capital, to commit technical assistance to MDIs, as is combined with the ESIP money and others. There's basically wind at the backs for some MDIs now. We're looking to capitalize on that, working with larger institutions, partnering with MDIs.
Gentleman's time's expired. The gentleman from Nebraska, Mr. Flood, is recognized for 5 minutes.
Thank you, Mr. Chairman. We've spent a lot of time today examining the specifics of the Federal Reserve's report on the collapse of the Silicon Valley Bank. That's a very important topic, no doubt, but I'd like to focus my questions today on the FDIC's report on deposit insurance. Chairman Gruenberg, the FDIC's report on options for deposit insurance reform recommended an expansion of deposit insurance for business payment accounts. If business payment accounts were fully covered under deposit insurance, can you speak to how the FDIC would change banks' assessments to pay for the increased insurance?
Depending on the increase in the deposit insurance fund, assessments would have to be increased to account for that. And that's really one of the trade-offs here. If you're going to consider ways of expanding the coverage of deposit insurance, you really have to balance it against the cost to the industry of increased assessments. It's one of the reasons among the options we reviewed, we thought that a targeted approach focused on business payment accounts, which is valued by businesses, valued by the banks for the relationships that they can develop with businesses, has particular promise, both because of the impact a failure of a bank with business accounts could impose. It could have financial stability implications, but because of the narrow nature of the account, where if a bank has a business payment account, rather a small business, it's really not in a position to open up multiple accounts. They really need the one account with the one bank.
For the payroll, basically.
For the payroll. So in terms of moral hazard, it is mitigated. In terms of financial stability, it's meaningful. So if you're going to look at increasing coverage, that was the place we thought might make the most sense.
And how are you, when you explain this, how are you thinking about community banks when it comes to these assessments? I mean, obviously Nebraska is full of really healthy, good community banks. They're talking to us about how they're going to weather this storm with potential assessments. How do you see that happening with this change in FDIC insurance?
Look, I think this kind of account would be arguably particularly beneficial to smaller institutions because they have close working relationships with small business. It's really the bread and butter. So that being able to offer a higher coverage for these business payroll accounts might have particular appeal. You really then have to think through the costs associated in terms of where you, if you want to go down this path, where you might, how high you might want to go, how high the coverage might be.
So when you go in and conduct an examination on one of these banks, do you have the resources now to be able to look at, you know, when your examiners go in there and they start sifting through all the different depositors of an institution, do you have the resources you need now to be able to effectively regulate this this change in FDIC insurance, or is that going to come at, you need more people for that?
Yeah, that's an important question because, and we highlight this in the report, if you're going to go down the path of considering higher coverage for business payment accounts, there's an issue of definition, and you want to be sure you have clarity so that we're covering the kinds of accounts that we're really intending to, and in a sense don't broaden deposit insurance coverage for other kinds of accounts that really don't serve the purpose. So there'll be, I think, an operational challenge in implementing this, something that our examiners would have to be attentive to. It's one of the issues we'd have to work through if we wanted to go down this road, and it would require a legislative change.
And the last thing I want to talk about is if you make these changes, and you have to regulate, you have to examine, I worry about increased compliance burden on the banks, on the insured, institutions. I would caution we got to remember, these small community banks serve rural America very, very well, and any heaping of additional compliance expectations makes it hard for a lot of these state chartered banks that are serving an ag community to exist. I'll just give you a chance to react to that.
No, look, we're keenly attentive to that, and we do have some experience, as we outlined in the report, that in the aftermath of the 2008 crisis, we did implement the so-called TAG program, which was a variation of this type of account, and it was extensively used, particularly by smaller community banks, and they found it quite beneficial.
My apologies, my time's expired. I yield back.
The gentlelady from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Mr. Chairman. You know, everyone keeps talking about, could the regulators have been faster, more forceful? Absolutely. Did the Trump-era deregulation shield Silicon Valley from enhanced supervision oversight? No doubt about it. However, at the end, I want to talk about the real root cause, really, of Silicon Valley's failure. It's their mismanagement and personal greed. And so if you look at the timeline, gentlemen, I really want us to look at this. At the end of the day, as you can see, some of the decisions made by senior bank employees led to their downfall. Importantly, these decisions were all shaped by compensation packages that incentivized unsound risk-taking. Would you agree, Chairman Barr?
Yes.
Vice Chair Barr. Sorry.
Yes, I do think that bank mismanagement was at the core of this, and
Yeah.
in the incentive compensation plans that the board put forward, risk management was not included in that
Yeah.
at the time the bank failed.
I mean, last year, look at it. The CEO salary was roughly, what, $1 million? But then he enjoyed over $5 million in stock awards and $2 million in stock options. During that time, did they get something from the federal government that said, hey, the feds were like, yo, something's going on here? Didn't they around that time?
I'm sorry,
When did they get contacted by the feds?
with respect to their risk management
Yes.
issues, they were contacted throughout this period of time, beginning
What year?
early on in 2019, 2020,
That's
21,
right.
22.
So 2021, this is what he does. I was just asking how it's like, I'm literally like looking for the money. I'm like, cha-ching, cha-ching. Like all I see is like personal gain here. This is not even on the table. There wasn't room for it regarding the $5 million, I think, stock exchange. But Becker also, or was on in there, Becker also earned $6 million since 2020 from bonuses based on the net income. In 2021, that meant an extra $3 million. As depicted in the slide last year, the Silicon Valley Bank unwound like billions of dollars worth of interest rate swaps. Is that correct?
Yes, they did. They
This
removed
does-
interest rate hedges.
This does not make any sense in terms of protecting against rising interest rates, but it does make sense when it comes to compensation depends on the bank's net income, or what we call in Detroit, AKA personal gain for bank executives. Terminating the swaps may have left them even more vulnerable to rate increases, but it boosted the bottom line, likely out of red and into black. Why do you think they did that, Chairman Grunberg? Why do you think they did that?
For financial benefit, Congresswoman.
That's right. No, I really want to make the American people understand what exactly happened, because everybody's so focused on what you all did or did not do, but at the end, they didn't respond. Did they respond to any inquiries that you put in, Vice Chair Barr?
The bank did respond to regulator
what?
citations, but those responses were insufficient. They were not sufficiently timely and sufficiently aggressive.
So, you know, my colleagues did talk about Section 956, and I know all of you are working on it, correct? You all agreed that you're working on it, which is important, because I really think you actually have the capacity and probably the maybe legal authority to go ahead and claw back. Do you agree that part of this proposal that you're looking at in regards to implementing Dodd-Frank's 956 regarding extreme compensation, bonuses, so forth, is it going to include clawback?
The proposal that was drafted in 2016 included a clawback provision, and
Are you all talking yes or no? Is clawback going to be one of the things that you are going to include in your proposal?
I will say personally, I think having that kind of
That's right.
provision makes a lot of sense. We haven't reached a determination as a
Yeah,
group.
American people want you to do the clawback. Trust me. How about you, Chairman?
Yes, Congresswoman.
Yep.
I think it's very important we have strong executive accountability, so yes.
Chairman Harper.
Yes, on clawback, and we need to make sure that it would have applied in the situations you described.
Oh, absolutely. And, you know, I think it's important because I'm working on a bill right now because not that I don't trust you all, but I saw what happened in 2016. And so, you know, I'm working on a bill because it's been 12 years. I mean, come on, it's 12 years. And so I want to work on establishing rules that literally curb the incentive compensation structures that also will help create kind of like a fund almost, and again, I would welcome your feedback, but it basically would say that requires senior bank employees' compensation to be set aside to deferral fund and called back if executives break the law. Because, I mean, this is like a scam. I know you guys are not allowed to use that word. I'm gonna use, that's a scam. And no one is focused on the bank. They're focused on, oh, what should we do here? This is not the last bank that will do this because of greed. And we, the American people, are gonna have to pay. Thank you, I yield.
The gentleman from Ohio, Mr. Nunn, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'll sub in as the
I'm sorry, the
great
gentleman
state
from
of
Iowa.
Absolutely.
My apologies
Absolutely.
for the chair's mumbling. The gentleman from Des Moines, Iowa, Mr. Nunn is recognized.
Mr. Chairman, very much a privilege. We are going to talk a little bit about Des Moines, Iowa today. You know, as a freshman on this committee, in the last 3 months, we've seen 3 massive bank failures. Last week, I got to take my 16-year-old out to get a first car loan. The scariest thing about your 16-year-old driving shouldn't be the question of, is my bank going to be there next month as a result of what's been going on here? I want to highlight the fact that everyone has now concluded on this committee that it's not fair for my small mom and pop bank in a place like Creston, Iowa, which has 96% of its depositors insured, to pay for this risky lending behavior, particularly by banks like Silicon Valley Bank, where just over 1% were insured. So I want to begin, first of all, by applauding Chairman Gruenberg for heeding the advice of this bipartisan committee, as well as the work that you've done to ensure that small banks were not punished by the FDIC special assessment. Mr. Chair, I want to go a next level deeper here. Do you think that going forward, regular deposit insurance assessments should also factor in the unusually large levels of uninsured deposits? Why or why not?
I think that's, I think the answer, frankly, is probably yes. It's one of the things we identify in our report on deposit insurance. One of the tools we have is risk-based pricing. And in light of this episode, we may want to consider increasing risk-based pricing based on levels of uninsured deposits. That's certainly something we have authority to do and something we can look at.
And I appreciate you looking at that. I'm going to take it to a next level then. Why should banks that are under more conservative management or higher FDIC, like my rural guys in Iowa, have to pay the same pro rata premium assessments that those banks that take on this greater risk?
They shouldn't, and we do have a risk-based pricing system. The challenge here is getting the risk-based pricing right. And for uninsured deposits, that may be a risk factor that we need to take better account of.
So is the FDIC prepared to take a more serious look at some of the risk-based calculations, and do you have a plan for how you're going to do that?
That was outlined in our report, and is something we are going to follow through on.
I'm heartened by that, and I thank you for taking a holistic approach to that. Vice Chair Barr, your fellow governor just last Friday, Mickey Bowman, gave a speech where she stated, "We should be careful and intentional about any significant changes to the regulatory framework, including imposing new requirements that will materially increase funding costs, like higher capital requirements." She's agreed with many of us here on this committee that the bank failures that we saw were the direct result of mismanagement and supervision, not the current capital regulatory requirements that some on the other side of the aisle may say. Do you agree or disagree with Governor Bowman on her assessment?
I agree that we should be careful and prudent in thinking about how to make capital changes. I do think it's appropriate for us to look at whether capital requirements for firms $100 billion and above are appropriate in the current circumstance. One area we're looking at in particular, for example, is whether we should use the rule that changes in the value of available for sale securities should be taken into account in the capital requirements. If we do make such a change, we would do that through a normal notice and comment rulemaking process with appropriate transitions. That's one example of what we're looking at.
And I respect that example. My concern here is that, in the words of John F. Kennedy, never let a good crisis go to waste. And I'm concerned that the Fed specifically is looking at exploiting what has happened over the course of the last 3 months with these 3 banks as an opportunity to really open up the regulatory channels and start governing by fiat in a way that really it should be in the role of Congress. Would you agree that you're going to be caging yourself after this series of committees on what I think is really some regulatory overreach, given that there are 3 very unique banks here, and it does not reflect the larger financial sector?
Well, we'll be looking at capital in the system as a whole. I began a holistic review of our capital requirements in July when I arrived. I think that it would be prudent for me and for my fellow regulators to take into account what just happened to our banking system, rather than to shutter our eyes to that. So I do think it's important.
I appreciate that, but I think Governor Bowman said it very clearly here. You had the capability to go after these banks. When Silicon Valley Bank took out a massive level of risk, when they had the opportunity to have a risk officer who was asleep at the switch and not even existent for 8 months, we had a diversity of other positions included. You had the ability to go after SVB, and as even my colleagues on the Democratic side have highlighted, those safeguards were not protected. So I have a real concern when we think about exploiting a crisis to have more regulatory authority when you have those tools already in your toolkit. With that, I'll yield back.
The gentleman from North Carolina, Mr. Nichols, now recognized for 5 minutes.
Thanks so much to our witnesses for your testimony today. I appreciate you coming back, those of you who did, second time here in 2 months. Vice Chair Barr, Chairman Grunberg, I also want to thank you for your hard work, reviewing the recent bank failures and keeping the committee informed, and for being here for quite a while today. I know we're near the end and certainly a long day. As I told you the last time you were here, my constituents are worried about making ends meet. The last thing they need to worry about is their bank failing. I'm looking for more accountability. That's really the focus of my first set of questions here, Vice Chair Barr. My constituents deserve to know that we will hold bank executives and regulators accountable and ensure that this doesn't happen again. Vice Chair Barr, the Fed's report says that supervisors, quote, did not fully appreciate the extent of the vulnerability at Silicon Valley as Silicon Valley Bank grew in size and complexity and did not take sufficient steps, quote unquote, to ensure that SVB addressed its problems quickly. And I asked you this last time about accountability, who was asleep at the wheel. Now that you've had more time to review this matter, can you tell me about individual accountability?
Ultimately, I'm accountable for ensuring our supervision and regulation is effective. It was not in this case, and I can tell you I'm committed to making significant changes to make sure that doesn't happen again.
Was anyone fired?
There have not been any employees of the Federal Reserve fired as a result of this. We did not find any unethical conduct. We did find judgments that could have been better and actions that could have been stronger. And as I said, I'm committed to fixing that.
Thank you. I'd like to move on to capital requirements. This morning I received your answers to my questions for the record from our last hearing and have some follow-ups. Access to capital for small business, especially minority-owned businesses, is one of my top priorities. The thriving community of startups in my district, many of them biotechnology companies saving, extending, and improving lives, rely on banks for capital. I'm alarmed by increasing reports of a credit crunch, particularly for small business owners and minority business owners that are likely to be hit hardest by this. The Basel III Endgame rule expected later this year will materially increase the capital requirements for banks. This will limit these banks' ability to lend into the economy and support capital formation in areas like mine in North Carolina. Just to be clear, Vice Chair Barr, banks under $100 billion will not be subject to increased capital requirements?
That's right. The focus of our reform efforts is with respect to capital, is on banks over $100 billion in size, and the potential significant increases in capital requirements are really focused on very large firms with very large trading operations, not with respect to smaller firms serving small businesses.
And have you considered the impact that higher capital requirements might have specifically on minority-owned businesses that already face significant barriers to accessing capital?
Yes, we look at the impact of a rule across the board, including its effect on small business lending when making adjustments. As I said, the adjustments we're thinking about with respect to Basel III Endgame that the agencies together are considering are primarily about significant adjustments to the trading book for the very largest financial institutions in the country. They're not about small business access to credit.
Specifically, though, I'm asking about the impact capital requirements will have on minority small business owners. Have you conducted an analysis in your holistic review on this?
We don't currently anticipate that the kinds of changes that we're talking about would affect the institutions you're talking about. We're really focused on capital requirements on the largest institutions in the country who have very active trading books, and that's primarily driving the changes in Basel III Endgame.
So when we consider the structural barriers for minority entrepreneurs, the rising rate environment, inflation, and again, reports of a credit crunch, do you think this is really the best time to get into raising capital requirements?
As I've said, any rulemaking that the agencies do would be formal notice and comment rulemaking with appropriate transition periods. So we're not trying to design capital requirements for tomorrow. We're thinking about, in several years, what should capital requirements look like when fully implemented.
Thank you so much. And Mr. Chair, I yield back.
Jim yields back. The gentlewoman from Texas, Ms. Dela Cruz, is recognized for 5 minutes.
Thank you so much, Mr. Chairman, and thank you to all the witnesses for being here today. I would like to start with Vice Chair Barr. One of your Federal Reserve colleagues, Governor Bowman, echoed some concerns in recent remarks when she said the unique nature and business models of the banks that have recently failed, in my view, do not justify imposing new and overly complex regulatory and supervisory expectations on a broad range of banks. If we allow this to occur, we will end up with a system of significantly fewer banks serving significantly fewer customers. Those who will likely bear the burden of this new banking system are those at the lower end of the economic spectrum, both individuals and businesses. Do you agree with her assessment?
I don't agree with that assessment. I think that capital in general is facilitating strong lending to all communities, and having strong capital in the system is critical for doing that. Of course, any changes that we propose, we are talking about the largest institutions in the country, institutions over $100 billion in assets. The kinds of capital requirements that we're talking about are requirements that would help those firms better account in their capital for their actual risk, such as making changes in the way unrealized losses and gains from securities are treated for capital purposes. And the kinds of changes that we're talking about would be implemented after a formal notice and comment rulemaking and with appropriate
I yield my time back. Let me ask you, Governor Bowman, how long has she served in this capacity?
I actually don't know when she arrived at the board.
Okay. And let me move on to something else because I am on a time crunch here. In your assessment and in the report that you gave, you made a comment that said supervisors recognized a gradual increase in liquidity and market risks, but they did not fully appreciate the risks associated with the concentrated deposit base or SVBFG's investment portfolio strategy. Vice Chair Barr, what did you mean by did not fully appreciate?
I think you can see from the findings of our report that supervisors saw, for example, the procedural problems with interest rate testing and liquidity testing, but did not see fully the vulnerability of the firm as a whole. And that's an area that I think we need to do better on.
Now, need to do better on is, and you said nobody has been fired for their lack of appreciation. Is that correct?
Yes, at this time, nobody has been fired. As I mentioned, we are looking across our supervisory system to make sure that it's functioning well, that we have the right tools at the supervisor's disposal.
Sure, I did hear that, and I thank you for your comment. I think as a small business owner myself, when someone makes a mistake of this magnitude, that we need to act quickly, and someone not fully appreciating costs American taxpayers. It's put us all here today, and it's somewhere where someone does need to be fired for their lack of appreciation. With that, I yield back.
Gentlelady yields back. We have a vote series on the floor. It's 2 votes, a PQ and rule. We'll take a brief recess until immediately following votes. The committee stands in recess.
so it doesn't.
Committee will come to order. I want to thank the panel for waiting, and I hope they're able to get a brief lunch break in the long vote series. We'll now go to Ms. Williams of Georgia for 5 minutes.
Thank you, Mr. Chairman, and thank you to all of our witnesses here today. Y'all, it is not lost on me that on the other side of the Capitol, the executives of the failed Silicon Valley Bank and Signature Bank have been testifying before our colleagues in the Senate and sharing their different perspectives from the regulators before us today. From my relatively short time in Congress, I've learned that conversations often happen in silos, while powerful stakeholders point fingers and the most marginalized become collateral damage. I hope today's hearing connects the dots and paints a more complete picture for my constituents and all Americans who are concerned about the stability of the banking sector. Mr. Barr, the former CEO of SVB, Greg Becker, testified in the Senate that SVB's growth accelerated because of the government stimulus measures in response to the COVID-19 pandemic and near zero interest rates designed to stimulate economic activity during the pandemic. Becker also pointed to the Fed's perceived signaling that they would keep rates low as the reason why his institution invested in U.S. Treasuries, which lost value when the Fed raised rates rapidly. Essentially, Becker argued that the Fed's monetary response to the pandemic influenced decisions SVB made, and those decisions were to blame for the sizable hole that developed on SVB's balance sheet. As a member of Congress who received text messages from constituents worried about meeting payroll on March 15th, I want to ensure that we don't lose sight of the impact that these failures have had and can still have on marginalized communities. We should thoroughly investigate this matter to understand what went wrong so that we can take steps to ensure that this does not happen again. Mr. Barr, do you agree with Mr. Becker's assertions that the government's pandemic response and the Fed's monetary policy forced his bank to rapidly double in size? And if this were true, why did not all other banks experience rapid asset growth and double in size?
Thank you very much for the question. SVB's growth was significantly in excess of the sector's average over that time period. They grew dramatically for a wide variety of reasons, but the basic point is that as they were growing, they failed to manage their risks. They failed to manage interest rate risks. They failed to manage liquidity risk. Those are the obligations of the bank to undertake, and they failed to do that.
So others have raised concerns that two very important Fed functions, its monetary policymaking and its bank supervision, were not successfully communicating, which can have obvious implications for ordinary Americans that rely on a healthy banking system, especially when there's a crisis that ultimately disproportionately impacts vulnerable and marginalized consumers. For example, the Fed conducts regular stress testing of the largest banks, but rarely tested a rising interest rate environment that we've been in the past year. Mr. Barr, what steps can the Fed take to better manage their dual responsibilities of bank regulation and monetary policy?
Thank you for that. Obviously, when we're looking at monetary policy, we consider the economic impacts of bank stress. So we anticipate, for example, that there'll be additional credit tightening coming into the system. We take that into account with respect to monetary policy. And on the supervision side, supervisors are, of course, well aware and have been well aware since the fall of 2021 that we are and will be in a rising interest rate environment. It's the responsibility of bank managers to take that circumstance into account in managing their interest rate risk. Supervisors did test for interest rate risk at Silicon Valley Bank. Silicon Valley Bank was failing its own internal stress test for interest rate risk. And rather than adequately mitigate that, they tried to change their test so it would be less conservative. They took off their interest rate hedges that would have helped to protect them somewhat from rising rates. And so it's just, as I've said, a textbook case of bank mismanagement.
So I want to zoom out and look at this a bit more broadly. Mr. Barr, how often and with what level of scrutiny does the Fed consider impacts of its supervisory and monetary decisions broadly on marginalized consumers and people of color?
We do take those considerations into account when thinking about our monetary policy. Obviously, there are differential unemployment effects, for example, in Black and brown communities compared to white communities. That's part of our thinking about how the economy is doing as a whole. And similarly, with respect to supervision, particularly when we're looking at performance under the Community Reinvestment Act, we're looking at how well banks are serving low and moderate income communities.
And Mr. Barr and the rest of our witnesses, I'm going to run out of time here, but in most hearings, I bring up the fact that Atlanta is the city with the largest racial wealth gap in the country. And if y'all are tired of hearing me talk about it, I can assure you that Black Atlantans are tired of living it. So I have more questions that I would very much like answers to for the record. Thank you so much, and I yield back, Mr. Chairman.
I thank the gentlelady for yielding back. We'll now recognize the gentleman from Tennessee, Mr. Ogles, for 5 minutes.
Mr. Chairman, thank you, and to our panelists, our guests, we appreciate you. I know it's been a long day, and obviously it's been a tough few months. Just jumping right in, Mr. Grunberg, in remarks you made in March to the Institute of International Bankers, you noted that the banks had suffered unrealized losses to the tune of about $620 billion in their held-to-maturity assets. In your review of the FDIC supervision of Signature Bank, did you find that the supervisors were aware of the unusual scale of the interest rate risk and the liquidity risk in the banking system?
Yes, Congressman. I think the report done by the Chief Risk Officer of the FDIC, I think identified that the examiners were aware of the issues, provided guidance and direction to the institution, and the report acknowledges that the institution was not timely or responsive. I think the issue raised is when you have an institution, unlike most, that are not responsive to supervisory guidance and direction, the supervisors need to take the next step in order to compel compliance to deal with unsafe and unsound matters. And I think in this case that didn't happen, and I think that's perhaps the key finding of the report.
Yes, sir. And then Mr. Barr, same question as it pertains to SVB. Were they aware of the unusual risk at hand?
Yeah, so the SVB report that we issued found that supervisors identified interest rate risk and liquidity risk that the bank was vulnerable to, and conveyed to the firm the necessity of addressing those risks. The bank did not respond in a timely way, and supervisors did not escalate that matter quickly enough before the bank failed.
Well, and that's kind of the point that I want to hit on for the two of you. Is there anything in current regulation that would have prohibited the ability for supervisors to escalate and or compel compliance?
No, they're not restricted under our current approach from doing that. I think the question is whether we can better design our supervisory system so that they both have the skills and the tools and the incentives to do that promptly.
Mr. Grunberg.
And I agree with that, Congressman. Examiners had the authority. It was a matter of exercising it.
And then, obviously we have got regulation and then we have rules. Is there anything in the rules that prohibited the escalation or the compliance?
With respect to our regulatory structure, the standards that supervisors were meant to apply to the firms changed as the firm grew. So in the early phases of its growth, the supervisory standards by our rules were lower. So those would have, in effect, delayed application of higher standards by about 3 years.
Until they met that threshold, right?
I'm sorry.
Until they met that threshold, that next
Until they
level,
met
right?
that threshold. And then partly because of our rules, there was a transition period in the rules that was both complex and perhaps too long, that made it difficult for supervisors and the bank to know precisely when they should meet that higher standard.
And that's a great point. And so I think as we look at the regulatory structure, the rules between obviously we're talking about California and New York, I want to caution any request for further regulation or for further rulemaking, when I think what we need to do is do a deep analysis of how do we improve the current system. I mean, I think, I've said it once and I'll say it again and I'll probably use it over and over again. Reagan caution, the scariest phrase in the English language is I'm from the government and I'm here to help. And so oftentimes when we take action or take action by rule, there are unintended consequences. We have a system in place and you have two different agencies that quite frankly fail to escalate under the current environment, right? You've got trillions of dollars going into the economy. You know that there's going to be the risk of capital flight because of the change in the bond and the interest rates. Where were the regulators? They were asleep at the wheel, quite frankly. And so what can we do to create a culture and an environment? Maybe it's more training. Maybe it's, I don't know what it is. That's your jobs, right? But I just want to say, don't ask for more authority when, quite frankly, in my opinion, you didn't leverage the authority you had appropriately. And now we have this huge systemic loss amongst the top tier of our banking system, which is creating uncertainty amongst all the banks. And coming from I've got an urban, suburban, rural district, my community banks are worried at what you all may do and what's that downward pressure, not to mention the whole tightening of the credit market. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Texas, Mr. Green, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I am just amazed at the language that I'm hearing here today. We are an oversight committee for banks. And one would think that we are of the opinion that the way you perform oversight is to punish the regulators. I'm just amazed that we should take actions to deter bankers from taking unreasonable risk and then walking away with a reward. That's what we should be doing. Making speeches about regulatory overreach, that's not going to prevent this kind of unreasonable behavior. Talking about regulators being accountable, that won't do it. Firing regulators. Don't talk about firing bankers for unreasonable behavior. Don't talk about punishment for bankers for what they do to create the crisis. Ultimately, the bankers were the people who committed the offense. They're the ones who are exposed to liability. The regulators have a job to do. But their job is not that of banking themselves. It's the bankers who have to be held accountable and liable. Regulators have no liability here. And I'm just amazed. This whole hearing has been about maintaining the status quo. A status quo that's given us what we have today that's causing us to be here. Don't overreach. I don't know, is there a term, underreach? Seems as though we're proposing, let's make sure we underreach. Don't do anything to create a means by which bankers might be punished. Don't talk about how will this committee work toward improving fines and regulations such that bankers can be punished for this kind of behavior. The public wants to know what's going to happen to the bankers, the people who took this unreasonable risk. There's no evidence that anything will happen if you listen to this body today. And these are my friends. I love them all, but they're wrong. At some point, reality has to become a part of a hearing. And the reality is the bankers knew of the risk, didn't have risk management facility in place, made a lot of money by giving themselves bonuses at or near the time the bank failed, by the way, and they walk away, and they're probably out getting other jobs. Don't talk about what's going to happen to them. I am just amazed. So here's where I land on this. If we fail to do what is necessary to claw back this money that they received as bonuses at or near the time the bank failed, we will have done the public a disservice. We will have done banking a disservice. That's our job. We're not here to protect the bankers, to make sure that they get off scot-free. It's time for us to do our job. So let me just simply ask this one question. The GAO official who was before us recently said as much, but I want to find out if you agree. He said, ultimately, at the end of the day, it's the bank that's responsible for what happened. At the end of the day, the bank is responsible for what happens. And I would add the bank is liable. Do you agree with this, that the banks are responsible for what happens? Since my time is about to expire, if you agree that the banks are responsible, just do this. Extend a hand into the air. Doesn't matter whether it's your right or left. Let the record reflect that all of the members of the panel extended a hand into the air. The banks are responsible. And as responsible agents, they have to be put in check. That's our job. And I plan to do my job. Mr. Chairman, I will yield back to you some 5 seconds.
The gentleman yields back. I now recognize myself for 5 minutes. Thank you again, gentlemen. Mr. Barr, may I ask you, do you feel the San Francisco Fed did a good job related to SVB?
The report that we released suggests that both the board in Washington and the San Francisco Fed did not hold up the bank with enough pressure, did not force the bank to act with enough pressure to act quickly enough.
Okay. Did anyone at the bank or at the Fed, or you hear sometimes that there's a lot of blame to be put on S2155. Do you think S2155 is to blame? And at the same time, isn't it true that when there's red flags are waving like they were from SVB, that the Fed has discretion to investigate further regardless of S2155?
The 2018 law does give the Federal Reserve significant discretion to implement the law, and in the case of the 2019 tailoring rules that resulted, it did, the report found, inhibit the Federal Reserve's ability to take action in a prompt enough way, and that's why we're looking at changing those rules, but we can do that within our existing authority.
Well, you just said two things, but the fact is that the Fed had discretion when you see significant problems taking place, regardless of S2155.
Yes, I agree with that, and the report finds as much.
And Mr. Barr, you also stated earlier how important it is to have a full range of banks, community, regional, super regional, mega. Mr. Grunberg, do you agree with that?
I do, Congressman.
Okay. We're hearing things such as, even from some large banks, that, and I quote, "The problem with regional banks is that regulators think we're too big to fail, but too small to succeed." What do you say about that statement, Mr. Grunberg?
Well, as a general matter, the regional bank sector in the United States is highly competitive and has done quite well and really fills a very important niche in the financial market. We've had issues with these institutions which are very serious, but as a general proposition, I think the regional banks are a source of strength for our banking system as a whole.
Do you feel the FDIC is doing much or doing anything to give regional banks equal treatment to the mega banks?
Yes, and if anything, I think the prudential requirements that apply to the so-called GSIBs, the largest institutions, on balance, are a bit more stringent than on the regional institutions.
Okay. Hey, regarding the special assessment proposed plan, I was reviewing it, and I got a couple of questions. Let's, we understand that under $5 billion bank deposits are exempt. Okay, that's very good. Community banks really appreciate that. So let's say there's a regional bank, and I'm just being hypothetical here, that has $205 billion in, to make the math easy, $205 billion in deposits. The new fee on top of the current fees is 12.5 basis points, or 0.125. So basically, that bank of $205 billion in deposits is looking at now a quarterly payment on 0.125% of $200 billion, which is $240 million. So the same bank, again hypothetical, usually makes about 10%. So their net income is about $2.5 billion. So this assessment, this new assessment, is nearly 10% of the net income of that hypothetical regional bank I just outlined. So they're paying for SVB's malfeasance, First Republic's terrible mismanagement, Signature, whatever occurred there. That's a significant hit, nearly 10% of their annual net income.
And I'd have to go through the arithmetic of your example. I can tell you as a general proposition, We estimate that the special assessment will have a 1/4 impact on earnings of the affected institutions on average of 17.5%. And then the payment would be stretched out over an 8-quarter period so that the liquidity impact.
Well, I got a question there. Did you, number one, did you get any feedback from the regionals as to something like, could they handle this? Secondly, why not an extended period of time as opposed to 4 quarters? And then thirdly, why not a graduated or progressive fee? Might be more fair.
So one, this actually is a proposal, and we put it out for public comment. So there'll be an opportunity for all banks to comment on the proposal, and we'll get their feedback, and that'll be important. And then the payment is stretched out actually over 8 quarters, over a 2-year period.
2-year, okay, well, my time has expired. The gentlewoman from Indiana, Mrs. Hutchin, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Vice Chairman Barr, companies across the country, including in southern Indiana, have been dealing with the inflationary effects of rampant spending. When combined with supply chain issues and the lingering after effects of the pandemic, businesses are currently navigating what is already a fragile economy. Given these realities, do you believe that increasing borrowing costs through higher capital requirements for regional banks is a good thing?
Thank you very much for the question. We're talking about changes to our capital rules that would take many years to be fully effective. So we're not looking to change capital rules tomorrow. We're talking about issuing a proposal, a notice for comment that would then lead to a final rule and a phase-in and implementation period. In general, strong capital requirements for banks leads to more lending throughout the cycle, not less.
Have you taken feedback or engaged with small business stakeholders in determining the impact on jobs and economic growth your holistic review of capital will have?
Any rule that we propose would, of course, be a proposal, and then we would get feedback from the public, including if small business community wanted to provide comment on that rule, we'd be able to receive that comment and respond appropriately to it.
Vice Chairman Barr, there are privately insured credit unions in communities across the country, including in Indiana. While these financial institutions play an important role in their communities, they do not have access to the Fed's Bank Term Funding Program if they face an unexpected demand for deposit withdrawals. All financial institutions are susceptible to liquidity issues, but not all financial institutions are able to access this liquidity. Mr. Barr, as my colleague asked you earlier, was there a reason why these institutions were left out of consideration for the Fed's BTFP?
At the time of the announcement, we were quite focused on federally insured institutions and the stresses that they were under. We're not currently contemplating changing that facility at this time.
Why, so my next question was, do you have plans to open access to BTFP to privately insured credit unions? It sounds like you don't have plans to do that. Why not?
Changing the facility would require a determination, new determination, and we haven't seen evidence with respect to privately insured credit unions that would justify this kind of movement at this time.
Is it something you'd consider if they face the same types of liquidity issues we've seen?
I don't really want to get into hypotheticals about what the facts and circumstances might be.
Chairman Gruenberg, last week the FDIC issued a proposed rule on the special assessment that was made necessary by the systemic risk exception for SVB and Signature Bank's failures. Would you provide insight on how the FDIC board determined the parameters for this proposed special assessment to replenish the deposit insurance fund?
Yes, Congresswoman, thanks for the question. The proposal was really developed by, we have a division of insurance at the FDIC who are responsible for managing the deposit insurance fund. And they developed the proposal, I think, with a couple of things in mind. You know, under the statute, we're required to impose a special assessment to make up for the cost to the deposit insurance fund of the systemic risk exception. And we have authority to target the special assessment on those institutions that benefited the most from the systemic risk exception. The systemic risk exception was targeted on uninsured deposits. So I think, so in crafting the special assessment, that was really the baseline. The institutions that had the most uninsured deposits would pay the most. Although built into that was an exception for the first $5 billion of uninsured deposits, because it was pretty clear that community banks were really not part of the issue here. And as a general matter, they have a lower concentration of uninsured deposits. So that was really the framework that was then proposed to the board, and that we acted.
Thank you. I was certainly glad to see that smaller community banks, which had nothing to do with SVB or Signature Bank's failures, were not on the hook for the failures of management or supervisors. Thank you for that. I encourage that to continue in that regard. Quickly going back to Mr. Barr, on this issue of privately insured credit unions, why are they being held to a different standard or provided with less opportunity than other institutions?
As I said, at the time, the stress in the banking system that we were faced with was focused in federally insured depositories.
But how are they different? My time's expired.
Congresswoman, if I could just for 1 second. The Central Liquidity Facility at the NCOA is another option. Privately insured credit unions are eligible at that facility, although I recognize the Bank Term Funding Program has a better underwriting system simply because the collateral is pledged at par as opposed to discounted for unrealized losses.
Thank you. I would encourage you to allow the privately insured credit unions to participate. Thank you. I yield back.
Well, I want to thank the panel for being here for a long day. I would encourage each of you, if you would, please respond to members' questions for the record in a timely fashion. Mr. Barr, we're still waiting for your responses from the last hearing. And as we know from college work, as you remember from I mentioned this on the phone call yesterday. With college work, work begets more work, and if you get behind, it's tough to catch up. I want you to catch up. But we commend to you all the responsiveness to our members, and I want to thank all of you. And without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. The questions will be forwarded to them for response, and I would ask our witnesses to respond no later than June 16th. I want to thank the panel for your testimony. The committee is adjourned.